Yo, what's up, bro? Can you hear me? Just do a little sound check this time. Beautiful. Alright, we'll start in like 3 minutes. Definitely got a lot to discuss today, Hope y'all having a good morning. Alright. I'm gonna start at 5 o'clock, top of the hour. Alright, you guys. Let's start digging into some stuff, shall we? Alright, so as every other week goes, right? We gotta make sure we understand the landscape of the news. So, this looks like a pretty eventful morning, so we should be able to get something interesting. I do want to point one thing out, though, that could be, well, if it's been a little bit more like difficult for you to read price the last couple of days, since Monday, or I mean, I guess technically since Sunday, there's a reason for that. And that reason is something that I talk about all the time with my private community, in terms of the relationship and impact that the interest rate markets have on things. And I believe it's earnings. I think I believe we're in earnings season 2, if I'm not mistaken. Let me double check real quick. Yeah, we are, huh? Well, earnings have a pretty dynamic impact on things. It does cause an elevated volatility environment. Not nothing to be too extremely worried about. Um, it is helpful to, of course, I mean, a lot of times the earnings will definitely shake things up, but it's not anything to be too overly concerned about. The technicals are still much needed. Fundamentals that we discuss on a constant basis are constantly needed. It's always going to have a dovetailing effect. One thing isn't going to basically one thing isn't going to stop certain things from happening. It could increase manipulation though, so you just got to be aware and just treat it as you got to manage risk a little more tight around times like this, okay, or times like with earnings and like FOMC and all those news events, so on and so forth. But the ideas that we've already been discussing the last couple weeks from our private community the last couple months, they all still remain. So basically what I wanted to point out is if we take a look at the interest rate markets, we could see that we have kind of stalled out here. What is happening with this stream? Oh, whoops. So yeah, we could see how the interest rate markets have kind of stalled out on their way to getting up here. That may be very short-lived. It may not last that long. But when the interest rate markets fail to move, or if they're like being held or whatever the case may be, that sends reverberations through the market, because these markets here are literally, like I've always said, the bloodline of what occurs in this case for U.S. assets. They're the driving force behind why the DXY does specific things or doesn't do specific things. And when they're being held and not really moving that much, that could lead you to a consolidation. That can lead you to choppy conditions. And then you merge that with, like, say, a news event, or you merge that with something like earnings, or you merge that with, things being out of alignment in terms of, like, let's say like the S&P and the other two indices, maybe they're not going the same direction, they're just doing their own thing, or they may be consolidating, right? Or there's also another scenario where the assets that you're trading may be in consolidation, and same with the DXY, but then the interest rate markets could be running, like aggressively moving in a particular direction. Well, that is when you can use the interest rate market analysis to basically assist you in understanding which direction has a higher probability of being attacked moving outside of that consolidation. Now, that's not to say that it would happen in 2 minutes or a couple days, and it may happen in a couple days, right? Just depends. But that overall perspective helps you continue to keep your footing and have accurate assumptions in terms of what price could do inside of a consolidation, and it can help you trust a bias. Say everything's in consolidation, but the interest rate markets, like the yields are moving higher, and then the bonds are moving lower. Well, if we're in a consolidation, then that should lead to DXY going higher, and then that in turn would lead to, say, the indices, because that's what we trade, going lower in that scenario, right? Out of the consolidation eventually, right? So it helps you have like an x-ray view on what could occur. Also, it helps you confirm or negate specific ideas in the moment and as price prints. So it's a very, very helpful tool in terms of using the interest rate analysis. And then, of course, it's even better when you're coupling it with other things like seasonality and the COT, different things like that. At the start of this new month, I will do a fundamental analysis. I'll just do one of those to show the whole process, what I do. It's very simple. It's not complicated. And it's repeatable. It's constantly repeatable. You can constantly refer back to these piece of information, and it just helps you even further amplify the trust you have in bias. You know, I've been able to call bias basically for years at this point, like almost 3 straight years of knowing where price is headed. And of course, that, like I said in the last the last live stream, bias isn't everything. ICT says that all the time. Bias isn't everything, because you could mess it up and do something else wrong, like enter too early, get out of the trade, lose confidence because you were in a losing streak, but you could still be correct on the direction. So it's not everything, but it's best to understand bias and what's happening, right? Because if you don't, you could pick the wrong times to get in. Like, say you find a YouTube model buy, but we're in a bearish market. That buy should be looked at as short term. But if you don't understand where price is headed on the higher time frames, if you don't have things to confirm what you're thinking, then you can end up on the wrong side, right? Or if you have a good idea of where price is going, but you take a loss, if your mindset's not secure, right? Because you don't have experience in applying the things that you're trying to apply, then it can be hard for you to try to reason with yourself to get back into a trade. And as you guys have noticed, those of you that have been with me for a while, both my private students and the ones that subscribe to me on YouTube and follow the content I provide, there's continuation models all the time using pretty much every single model. Yesterday, we talked about the market maker buy and sell models, right? And we talked about showed one on the higher time frame on the DXY, and then we also showed some on the lower time frames as price was moving lower, right? So you can get a bunch of different things to go in your favor, and use specific things no matter what time frame you're on. Like, especially, like I said, the market maker buy and sell models, not only ICT's favorite, but it's also my favorite. Aside from like the breaker, because the breaker was my first model that I started to really gravitate to, because it's very it's very forgiving. There's 3 opportunities, right? The breaker runs above a high, breaks down below. So if it runs above a high and hits, say, a premium array, and we're bearish on the higher time frame, that is a way that you can trust turtle soup. Because a lot of times, if price was to, say, hypothetically run above this high, say this was the S&P, say if it ran above the high, but the NASDAQ failed to make that higher high, and we're in a bearish market, well, that's where you can start to reason with yourself to consider trusting turtle soup entries, right? But again, we want to be able to know what direction the price is going on the higher time frame. But that's just a scenario. That's one of those scenarios that made me really like the breaker, because you not only can have that opportunity if you're good at spotting SMT and you understand the PD arrays and how price hits those, but then once it breaks down below the low and then heads towards some type of sell side liquidity in this example, then you can also, when price returns back to that, you could take that entry, and that retracement that comes back into that last down candle, those consecutive up candles that lead to that, when price breaks down below, say this was the low, price rallied up, say it was a swing low, and it had a couple bullish candles after the first entry, right? And that second entry, when it's offered, once that low breaks again, those consecutive up candles generally act as an order block, right? I hope that makes sense, right? It's much easier if it's visual. So say like this. So this is price right here. Price runs above the high. If there's SMT between these highs in a correlated asset like the indices, you can take that entry. Once price breaks down below here, comes back into the last down candle or last down consecutive candles, that can be an entry. So you have one at this point with SMT to get turtle soup. Then you have the last down candle or consecutive down candles in something like this. That's your actual breaker entry. But this consecutive move that goes higher to retrace to that entry here, once that low is broken, this range can also be used as a potential entry opportunity as well if there's like an order block or a fair value gap. So you have 1, 2, 3 opportunities So it just goes back to what I keep saying, how there's also continuation models. Well, the breaker has multiple things going on, and you could take multiple entries. And inside of a breaker, the YouTube model generally presents itself here after the run-on stops. Unlike, say this is the 1 hour chart, and we see the breaker. Well, inside the 5 minute or the 1 minute, this run-on stops. The YouTube model will have a shift in market structure here. And again, that goes back to you understanding narrative. If you understand the narrative, you're able to trust this type of stuff and trade inside the breaker. If you've studied ICT for a while and paid attention to what he says about breakers, he doesn't need price to break through this low to trust the breaker in many cases. That comes from understanding narrative on the higher time frame. That comes from understanding the PD array that could be above the high. Merge that with SMT, potentially merge that with fundamentals. And then, you can have, some gangbuster results on many occasions, right? And yet you're basically getting 3 chances in a breaker. That's why I love it so much, right? So for those that don't know, the models I use are pretty much the market maker buy and sell models for framework and entry. The YouTube model, right? Breaker's my main go-to. And then the continuation models in alignment with that. And then, of course, the sole continuation model called the institutional order flow entry drill that has to just do with fair value gaps. And when price is moving away from a move that was presented, it'll create fair value gaps. And then generally the institutional order flow entry drill will leave half of the fair value gap open, right? And we can dig deeper into that if you guys would like eventually. But yeah, those are the only things that I look for. I mean, I can identify optimal trade entries. I can identify some of the other things. Generally, would be optimal trade entry as my backup. If I didn't see anything in any other model, which never really happens, there's always something in between those 4. But if I can't find those, I'm considering optimal trade entry as well. And then when I use optimal trade entry, my targets are generally the previous day or previous session's high or low, depending on the bias. It's very basic, to the point type of rules, from targeting to trying to see the entry pattern, right? So just matters what works for you, right? So again, nothing has changed from what we've talked about yesterday. The thing that has been observed is the fact that it's been kind of slow. And I just want to flip through these to observe any SMT that we could see. So there's no SMT between the bonds. Let's look at this too. Excuse me. Let's look at the yields, or the bonds too, because the bonds have 3 of them. This is a 30-year bond. This is a 5-year bond or T-note, right? The bonds or T-notes, they're interchangeable words. And then we have the 10-year here, right? So if we look at these lows, we can just observe and just see, was there any SMT? As far as I'm concerned, I mean, there is slight SMT here between these lows. But again, that's not enough, at least right now, especially if the yields want to continue going higher. That's not enough for me to think that this is not going to play out. You notice how it's working inside of this range here. It's just literally stuck. So seeing this, if you're struggling ever in trying to find an entry and prices seems like it's not cooperating, you instantly got to think about the interest rate markets. And of course be aware of things like earnings, right? Because that can also be a factor in price not really moving much if you're having a hard time. Then you also want to consider what current range you're inside of on the higher time frame, and whether we are in a premium, discount, or equilibrium price level. Because if we're at equilibrium in a price swing, and we're also consolidating in the bonds and the yields, and they're not moving at all, those are all, and you can also add that we're bouncing between recent new week opening gaps, like from one to the next, and it's just bouncing around. Those are all signifying factors showing that we are in a consolidation condition. And when you're in different conditions in the marketplace, that's one of those things that takes a little bit of time, because you have to learn how to operate in trending and consolidation and all these different things, because there's different ways to view things. Just like when you're in traffic with a car, you drive a certain type of way when you're going in one direction with no traffic, but when traffic comes, you have to act differently. You can't just floor it through traffic. You're going to get in a wreck, right? So look at consolidation like it's heavy traffic and it's just being held, and you can't really do much, sprinting. And just like how in traffic, if there's like a backed up traffic situation, there's a reason for it, right? There's probably an accident. There's something, along those lines. Well, if we're in consolidation in the marketplace, there's reasons and something that's holding price in that consolidation condition. You know what I mean? And that's basically the things that we've discussed, right? We could be at a higher time frame equilibrium price point. Price can be just consolidating inside of the bonds and the yields. We could be basically stuck between a couple new week opening gaps, bouncing back and forth. Or we could be ahead of a news event, a heavy news event like FOMC, NFP, so on and so forth. All right, those are all times that you're going to see consolidation. And when you're in consolidation, like I said, you want to be able to trust yourself that you're not going to overtrade, you're not going to push too hard. You got to trust yourself in the perspective that I don't need to take a trade today, especially if things are not doing something I'm comfortable with. Right? And there's ways to navigate consolidation and trade within those situations. I talk about that in my private group. I've done that type of conversation a few times. But when you're new, you don't want to push those types of conditions. Maybe in a demo, but you still have to follow your rules no matter what you do. When you open the chart, you have rules that you need to follow. I emphasized rules in pretty much all the live streams we've had so far, because if we don't have rules and we're not following them, we're just asking to get removed from this industry. There's rules for a reason. Just like there's laws for specific reasons in countries, just like there's specific ways to do things in a company as an employee. It's super important to follow these rules. And in this game, it's amazing because you can make the rules for yourself. But you have to respect yourself enough to know that when you tell yourself to do something, you're going to follow through with that, because that's like the pillar for self-confidence. And in this industry, that is so important, because if you don't have confidence in yourself to be disciplined and keep your money safe and do what you have to do, and identify what you need to identify and understand what you're looking at, it's rough. This is a hard game to play, but there's a method to the madness. And at the top of the list in terms of things that are non-negotiable, discipline and being able to trust yourself that you will follow the rules you put in place is paramount. Okay, so that's my slight rant before the session, right? It's one of those things that's super important, because everyone wants to catch an entry. What are the entries? How do I do this? How do I do that? Okay, well, you can learn all the technicals fairly quickly. Applying them, being able to navigate conditions, and then within those, that navigation of specific conditions and gaining that experience, you also have to be operating in a manner that, that's professional. Because, you don't want to be reckless, because the market cannibalizes people that are reckless, right? So to avoid your issue or the risk of being totally blown out, you're going to have to make sure you're following your rules. And you will miss trades following rules. As you have seen, you guys have literally seen me miss moves, but that hasn't kept me away from making good decisions after a missed move, because I understand how to navigate, and I don't beat myself up for missing something. I maintain a level head in terms of psychological management through a loss, through me missing trades, because I know it's going to happen over and over. And with all the models having continuation models, it's just even more reason for you to just relax. Wait for something to show the rules again, and then you can engage. Oh, nice, Trey. Trey passed his funded account. Beautiful, bro. Now the real game begins. Don't let that 100% win rate get you too high. Remember what I talked about in the other call. You got to manage the highs and lows very effectively. 100% doesn't last long, and you got to tell yourself this, convince yourself that that's reality. Because if you don't, and you sit on this, this super high expectation of 100%, and you're not considering the fact that you will end up losing eventually, when you do take a loss, if you're not accepting that that's reality, it'll hurt a lot more. And then that's when people spiral out of control, break their rules, and they don't do anything that got them to have that high win rate. You know what I mean? So just always be careful when you see 100%. But amazing job, bro. So yeah, nothing has changed in what I'm looking for in price. I'm still looking for the indices to go lower. I'm still looking for the bonds to go lower. Still looking for the yields to go higher, which means I'm looking for DXY to continue giving us reasons to want to go lower, or for DXY reasons to go higher. Okay. So do you guys have any questions? And no worries, brother. That's why I'm here. Yeah, it's needed. Without discipline, there is no trading. There is no success without discipline. I mean, and that kind of goes with everything. Without discipline, there's literally no chance, because you'll be victimized, and it's systematically done. Everything is systematically done to literally manipulate the human mind. And knowing that is the case, so to make sure we don't get victimized or have the ability or have the market we need to make sure we don't give the market the ability to cause ruin in our lives and in our account and in our psychological realm of things. So we got to stay disciplined. No discipline, there's going to be no success. So that's the thing. Next time any of you guys feel like breaking the rules that you've put down for yourself, remember, you breaking your rules is literally telling yourself, I'm going to fail. Eventually, when you get a little bit more versed in your skill set, yeah, you can bend the rules a little bit here and there, right? But that experience is going to help you know when you can do that. Otherwise, if you break your rules, you're just going to be doing it recklessly, and it's not going to be fun. Right? It'll be freaking chaos. So, okay, let's dive into more trading-based stuff. Okay, so we have this daily fair value gap, but inside that daily fair value gap, we have this weekly fair value gap. So the best thing for us to see right now, if we are going to continue to see price go higher in the DXY, I mean, it's permissible for price to play around in this fair value gap. It could just spend the rest of the week, since it's already almost the end of the week, it could spend the rest of it just chilling in this fair value gap here, right? I would like to see this act as a support level. I would also like to make sure that, I'd like to just have the opportunity to see price basically respect the midpoint of this, because if it respects the midpoint of this, that's further giving us evidence that this second stage distribution and this market maker buy model I've been talking about, it gives us more evidence that that's going to be trustworthy, right? So far, this is exactly, what we're trying to see. There's no like super aggressive rejection. It's just basically doing a normal retracement. And so with that being the case, we want to see how price is going to either respect the midpoint, which I'll outline here. We want to see how it respects the midpoint, or if it's not going to, and it's going to show us maybe it's not as bullish as it has been. All right, but all this run higher here makes it permissible, especially since we got a fractal high here, for price to reach lower into something, right? And we're basically seeing that come to fruition right now, right? And so everything is in line. Even though this is a down candle, we're looking at the higher time frame, we see that nothing has changed in the narrative, right? It's just a normal retracement. Nothing to freak out about, nothing to worry about. And we still have this wick up here. If we go to the 2 week, we could see this large wick here. So the midpoint of this wick is a decent target. Well, technically, the whole wick, you could use all the quarter levels as potential targets. We've already hit this quarter point, and then it rejected off of that. And then above that, we have this massive monthly fair value gap that could very well be what price reaches up into. If you look at this chart, you can see that there's just been the last couple of years, the last year or so, it's been consolidation in the DXY. It's just been a lot of economic craziness. And so yeah, I'm hoping that it could potentially reach up here. But if it doesn't, we have this run on stops here. I mean, technically it did run stops here. So this little range here, or you could use this low here, from this high to that low. That whole range is what we're working within, inside of. Right, but we could see how it came up, hit that quarter point, and has rejected. Right. So again, so far it looks like we're going to continue our press higher, which then of course is going to make us assume that the indices should press lower. Okay. So that is the narrative still to this very day. Okay, until something changes. And things start to change when we start seeing potential discount arrays getting violated. And then to further confirm that, we'd want to see other assets like the interest rate markets start to help and confirm whether that's going to be something viable to go off of or not, in terms of a change. But again, nothing has changed. So we stick to our guns on the higher time frame and practice trusting our higher time frame bias and not being swayed by day-to-day price action, but paying attention closely to PD arrays, how they're being respected, what price is reaching for, and the intermarket relationships that confirm or negate whatever it is that we see happening. Okay? So yeah, I want to see this midpoint here hold. Okay, because this is a weekly fair value gap that we just outlined. So inside the second stage distribution, this possible second stage distribution, we want to see price run up, and we want to see it slice through these up candles. We don't want to see those hold as resistance at all. Right? So yeah, and if price runs up here and then just dumps off the face of the earth and gets below this weekly fair value gap, or doesn't respect this midpoint, then I start considering, okay, maybe it's not as bullish as it has seemed the last couple days, couple weeks. Hope that makes sense. So yeah, with that being said, let's dig a little bit deeper. Okay, so that is the weekly. This is the daily. We're back inside this area. Not sure why that didn't. Okay, well we'll keep the chart clean. So yeah, prices dropped in. Oh, we just had a news event. So yeah, let's kind of quickly move over to this. So again, we're looking for price to drop potentially lower. So let's go to the 1 hour. Yesterday I outlined this as a market maker sell model. I literally made that as clear as I could, I hope. But we could see how this rally up, this consolidation, to rally, to now smart money reversal, first stage distribution, coming into our second stage distribution area, which should lead us to a quick sell side liquidity raid aiming for Friday's low. We also have London's high here. We had London's low here, this little blue box here. That's London session. So London session has now been basically purged. We see this inversion fair value gap that we can now use as potential resistance because we've gotten below it. So yeah, let's quickly go down into here. Watch these highs. How much you want to bet there's an SMT at these highs? Oh, okay. Oh no, it looks like there was here from this high and that high. See how it has lower high, but it has higher high here. Layer that with all the things we've discussed, how DXY should go higher, the market maker sell model I pointed out, and we are still in line with the bias that we've discussed the last couple of days. All right. So I hope that makes sense. So prices, of course, ran aggressively, one-sided so far, has not offered anything. There's nothing to be too excited about here. It's just the news came out and it just accelerated. Like if you were to try to take any entry, if you were to try to take a sell in here or something, price would have purged you out if you got in before the news event. We're also ahead of the open price for New York. So again, like I said yesterday, a lot of times at 5:30 or 8:30 Eastern, if there's a news event, things could occur and be excited before the open, but generally you want to wait for the open to show itself, because then that presents the if you trade before that, you're trading in the manipulation. And generally you'll get stopped out like this, and then if you were bearish like we are, price would basically take off in your direction, but unseat you because you entered inside the manipulation. So yeah, now we're gonna observe what is price looking to do. It looks like this is a retracement. Again, nothing in the bias has changed at all. Price has just taken out sell stops, and I believe respected the midpoint of that weekly fair value gap, and the daily fair value gap was fully filled here. Okay, so this purple line is a weekly fair value gap high, and we can see how now that's going to probably be used as support, basically showing the importance of higher time frame levels on the lower time frame. So we got previous day's high here. So previous day's high, in my opinion, is likely to be a target, and then previous day's low for the indices has already basically been been utilized. But yeah. So our bias for the whole entire week has been beautiful. From yesterday, I gave you all the market maker sell model consideration, and we can see how that's just beautifully, playing out. This right here could have been an entry using this lower portion of this inversion fair value gap. I definitely, at least in my opinion, want to wait. I want to wait and let some of this stuff play out, and then just see what happens as we approach the open price. So then we're looking at the fair value gaps here. We want to see, is price going to reach into it in one of them and then maybe leave that open? Or is it just going to use the midpoint of this wick here and just not even come close to this and then have this act as a breakaway gap? So like I said, the DXY is likely to go higher. DXY has now shown a willingness to go higher. We've got these equal highs up here. Like I said, this move here, this retracement, if DXY continues to go higher aggressively, then this will continue and just stay heavy, all inside the narrative that we're trusting, which is bearishness so far, and then the model of delivery for the current price, the price chart we're looking at, whether it's the S&P or the Nasdaq, it's inside of a market maker sell model, which basically was formed from the Sunday's open, gave us a manipulation above, set the high on Tuesday or Wednesday, gave us a smart money reversal on Wednesday, continued to drop, and now Thursday is looking like it wants to continue with that narrative. We're inside of the second stage distribution down here, so if we can get a retracement inside this, that would be, in my opinion, something I'm personally interested in, especially if DXY continues to go higher and we can get the yields to continue to go higher as well and the bonds go lower. Isn't it beautiful to see everything that we've discussed in the moment the last couple of weeks play out beautifully and just basically work lockstep in terms of the intermarket relationships, the targeting, where price is going and why. Like this is the process, right? It's when you study these markets, like the interest rate markets, and you get to visually see, like what we're doing now is gaining experience, applying this type of analysis, and you can literally see for yourself that this stuff is super valid, and you could be on the right side of the market more than you're not, right? Again, this is a move that was presented, right? It was not a YouTube model or anything, but this was a move that was presented. But because we're before the open, I personally I didn't want to take it. Right? Things aren't lining up 100% with a model for entry. The bias has clearly been lockstep, beautiful. These consecutive up candles could be something interesting. You could study this, see if this could be a potential resistance. I personally would like to see price run up above this high, stop these traders out, so then we compare ourselves with some form of buy side liquidity. That's what I would like to see to want to participate. But again, if that doesn't happen, and I'm demanding that, one thing to study would be these consecutive up candles here, because these are one order block on the 2-minute chart. And then you'd also study the midpoint. Is it going to respect? If it respects the midpoint of this, or just moves off of this low point, and doesn't really try to go higher, and the DXY continues to rage higher and the bonds continue to go lower and the yields continue to go higher, then this should be something that could hold. And then, of course, this is the second stage distribution area. And honestly, I'm starting to think that this here was the delivery of the second stage distribution. All right, this is the first stage. Second stage is here, and you could just see how the second stage distribution pumps quickly. It's a fast, low resistance liquidity run. And you can see this is all high resistance, but this was low resistance. So because I'm considering the fact that this is actually, from what we're seeing, is most likely the second stage distribution delivery right here, because this is our second stage distribution area. First stage accumulation, second stage accumulation, first stage distribution, second stage distribution in alignment with the delivery that was on the left side or the buy side of the market maker sell model. So we should see or be able to see characteristics of price just sliding through the lows here. Right, and all this perspective has been outlined for literally the last day. In my private community, it's been outlined for, the bias has been outlined for a while. And things don't change dramatically, right? And when price was in consolidation at the highs up here, right, up here at these highs, we were studying interest rates, the interest rate markets, we're studying seasonality, and all the things that are related to our process fundamentally. And we were just waiting. SMT formed, and then price just gave up the ghost. And we were ready for it. So again, I prefer to see price get above this high here, come and sweep this out so I compare my sells. But again, we have this fair value gap that's been hit. So if we are really bearish, this is going to be all it needs. Like if it's like second stage distribution bearish, which I believe it is, it may not offer us something above this high. It may just use this and respect the midpoint. So yeah. But we'll see. We shall see, won't we? Look at the NASDAQ. Yeah, there was SMT here too. So yeah, from this high and that high, see there was a lower high there. So that SMT cracking correlation here, in line with all the things that we've discussed, basically has been pretty fruitful. And we are now looking for the S&P, I want to see 5,039 as my target. So because the assumption is price is in a second stage distribution mode of delivery in the market maker sell model we've been plotting out, we may not see a very quick retracement. It may just want to tank because second stage distribution characteristics, if it is in fact correct that that assumption is there, we will not see a very quick retracement. I believe that that's most likely what's going to happen. It's just a fast continuation lower. That's what I prefer to see, of course. That's in line with everything we've been outlining. So 5,039 is what I want to see. Right here. What is that? That is the low of the market maker sell model. I mean that's the low of the of the second stage distribution in the market maker sell model. The low of the market maker sell model is down here, so price could want to reach all the way down into there at some point, but that's like much more than we need to see price attack right now. Again, we are ahead of the manipulation at the open, so the open, it could be pulling price down right now, and then the open can literally come and yank people's hair out coming up to the high, sweep these people out, then give us another opportunity in a better position. Not that this position isn't a good one, because I mean, shit, there's already 5 points that was offered there, right? There's already 7 points offered again, right, in a couple minutes. And yeah, we ran the risk of price wanting to retrace back up here. But like I said, given the context that price is in a assumed second stage distribution, I feel like it's pretty probable that it's not going to dig deeper, like too aggressively, which would have validated this as a potential good entry, with the consideration that the risk of us having to consider this high potentially getting attacked, plus we're before the open price. So if those factors are something you wouldn't be comfortable with, or if this is not something that you would employ for your model, then just look at it as you're studying the price delivery, how price is utilizing the order block versus an entry. And if you're in an entry, right, if you were, say you entered up here somehow, and when price is printing, when you see this order block or you see this fair value gap, as price breaks below that, you want to see how that's respected. Is it respected or not? Is that, because when it is respected like it is here, that's showing you the price is going in your favor. It's that you are correct, and you don't need to worry about price coming and stopping you out. You focus on what is relevant right now, what is important right now, right? Are things aligning with the thing that I have been trying to see in price action? And as far as how things are going right now, yet again, for like the sixth, I think it's like the sixth straight live stream, we've been able to identify what direction price is headed and identify possible opportunities, right? And again, I didn't participate in this one because I chose not to participate in it. I'm preferring to wait till 6:30 or what is it, 9:30 Eastern. But it is an opportunity clearly, and it offered 7 points, and the target is defined. It's outlined ahead of time. We identified the SMT also that was present here. This is actually an equal high. Is it? Oh, no. Well, technically it's a relative equal high, but there's still the SMT because this was higher than this, and the other, the Dow made a lower high. Right here. So that is beautiful. Oh, one thing I want to point out here as well. So you see this consolidation? This consolidated first stage accumulation, second stage accumulation, smart money reversal, first stage accumulation, first stage distribution, second stage distribution, one-sided low resistance liquidity run. So this small fractal is a market maker sell model on the lower time frame. So market maker models are freaking dynamic. Okay, they're freaking everywhere. You just have to build up your skill set to track them like a hunter, how they track footprints. Well, there's footprints in the marketplace that you can track. Like this here was a signature we were able to track. We're inside of the 550 macro, so this is also would have been a good move. All right, you can use the midpoint of this wick. See how that's respected? You could use the logic that this wick was also respected. So that's all different indications showing that this is going to hold. That we're continuing to promote the idea that 5039, which was the target outlined well ahead of time, is going to be fulfilled likely. So, yeah, and if we just look at what price looks like, take some of the stuff off. I mean, price when it breaks. Oh yeah, let's look at these lows actually. Okay, let's look at these two lows. Now let's switch to the euro. Okay, so made a higher high for GBP, and we made a higher high for. Actually, no. Use this high here. Wait, what date is that? April 11th. No, so yeah, there's basically no SMT to speak of that would be usable. So SMT wouldn't really be relevant here. But nonetheless, everything in terms of narrative and draw on liquidity, it's all still valid and nothing has changed. So what do? We trust the bias until something changes. And anything that goes opposed to this bias, you'd have to have your risk protocol lower, and you would have to make sure that you're managing your risk properly. So yeah, I hope you guys have been learning some stuff from the last couple calls, because a lot of the things that we've discussed are, I'm hoping they're not too complicated, and most of the things are very, very applicable, like the analysis concept between the interest rates and stuff like that, and then just how price reached down. Price is only going to do one of three things, by the way, for bias. It's either going to reach for some form of highs or lows, basically liquidity. It's going to create or rebalance or retrade to a specific PD array. Generally it's fair value gaps. It's going to either create, rebalance, or retrade to a fair value gap, or it's going to consolidate. So you have to ask yourself, what did price do on this weekly chart from this high? Price was retrading into a fair value gap. So once it's retraded into that fair value gap, what should it probably do? It should now look to seek buy-side liquidity. Went from internal range liquidity to now seek external range. Internal is anything like an order block, fair value gap, so on and so forth. External range liquidity, in this case being bullish, would be the highs, right? External liquidity in a bearish market is the lows. But lows in a bullish market are looked at as internal range liquidity, right? I hope that made sense. It's a little kind of more of an advanced topic, I guess, possibly. But yeah, so we've went from internal to external range, it looks like. So yeah, we're just continuing to press on. It's actually taken out or attempted to take out the previous day's high. Okay. I wanted to show y'all something real fast. This is our private community. So yeah, in our private community, we discuss every single element to our fundamental analysis process that has been keeping us in line with the marketplace right in front of your very eyes. So we dive into the whole process very deeply. And we've got like different models that get broken down to. Let me find... Where did it go? So it's not in there. What the hell? Sorry, I'm looking for something real fast. don't know where it went. But yeah, so looks like these down candles are being reached into. Price is probably going to use that potentially. It also could, since we're before the open, it could give us now a retracement to come down, tap into this fair value gap or something below us to pair smart money buys so they can come and ram these equal highs even more, because that was a very light run. I don't think we're going to dig this far, like coming down to like this. I don't think that's going to happen because we're like so close and things are clearly bullish. Can you please get in depth about news and which ones to avoid? Today there's 0 news events to avoid. The news events that you want to get rid of and never even consider, at least as a new trader, are FOMC, NFP, any type of Fed speech, right? Interest rate auctions or anything that has to do with interest rate, like anything that talks about the interest rates and whether they're going to raise them or drop them in the news, like interest rate, I forgot the rate announcements. That's what it's called, rate announcements. CPI, okay. And mind you, keep in mind, these are all things that you don't want to mess with engagement wise, but you still want to study them. If you're a new trader, if you're a little more seasoned and you already have a model and you're not going to beat yourself up and you're confident in your abilities and you're not, you take a loss and you could deal with that without spiraling out of control, beating yourself up. If you can't control that, then you absolutely stay away from trading any of the things that I just mentioned. That doesn't mean you don't study them, because you should be studying, in my opinion. If we're trying to trade and be full-time and do these things and try to progress quickly, there should not be one day that goes by that you don't at least spend 10, 20 minutes on a chart studying a specific thing, right? Freedom comes from the sacrifices you choose to make, right? And time, the time invested in something is what will give you the skill set, because it doesn't just grow legs and walk on its own, right? So as a new trader, you want to make sure that you're studying something very intentionally. I mean, that could even go as far as looking at a news event or a couple of them and studying exactly what price reaction was based on that news event, right? That's a really powerful study to do as well. And, like you go in and have intention when you're studying. Are you going to look for the model that you're trying to use? Get a bunch of examples of that. If you're looking for draws on liquidity and you're trying to study the liquidity pools and how price uses one, or how it, does power 3, or how it does any of these specific topics, you go in, and I tell my students to make sections in their journals for each topic that they're trying to study, because you don't go into the chart trying to look for everything that you're being exposed to. It's just everything, for one, is not in the chart every single minute. Every time you look at the chart, there's going to be some things and there's going to be some things that aren't there. You have to work with what you see, and understanding when to use specific things or how to identify specific things and validate them. All that stuff will come from experience, of course. But it all starts with you observing and, putting yourself in the fire. That doesn't mean getting a live account and trying to risk money when you don't have a plan yet. It's just you want to be able to start applying these things and get used to it. It's just like learning a language. You got to slowly ease your way in, learn the basics. You don't just learn one word and then go to like Mexico and try to have a full conversation when you haven't done the work yet, right? It's the same thing in this. Or like a surgeon doesn't read one book and then go try to operate on someone's heart, do heart surgery. There's time and experience that needs to be built. So this is no different, right? But yeah, that little news drill, right? Go in there, look at the news every week, see what price is doing, and then go study the reaction and take screenshots of it and put it in a portion of your journal, right? That journal can be a Discord, a private Discord. because it's very easy to organize. It can be a digital journal, that like a custom digital journal that I give my students, or something that you create. However you want to journal, just make sure that you have these separate categories, so that when you go into study, you're able to pull those things out and keep them organized. Like say that you're learning about order blocks. Well, everything you stumble across in terms of order blocks, so just so you don't have to go back 100,000 times and try to refresh your memory and go find information. Every time you're exposed to a topic that you like order blocks, for example, you should have a section for it. You should have a section for risk management. You should have a section for daily reflections, fundamental analysis, right? All these different things should have their own section as you're trying to develop into the trader you're looking to become, and you're trying to master the skills you're trying to master, right? And then of course you have your daily logs, right? Like in our private community, this is how it goes. We have community areas where people talk. We have different things for, goals, weekly report cards, homework that people do, the private calls that I have on Sundays and a couple times a week, different models, right? What model are you using? You want to have a section for that. The daily logs, basically what we're doing here, studying what price is doing live. Those types of things go in the relative month, and it's separate. I separate them all into months. It's the same way that I have my journal, and it's the same way that I tell everybody to consider journaling. Then there's fundamental analysis, little sections, right? Section for students who put their discoveries, so on and so forth, different points of interest in the study of those, right? So the whole point is you want to make sure you're very organized, because if you're not, and you're just blowing through videos, just exposing yourself to so much without actually focusing on those skill sets, so you can solidify them, it'll just take you longer, and then you're gonna have to go back, you're gonna have to look for it, and you'll probably lose where the stuff is at, and it'll just be added stress that's unnecessary, right? So we want to do it right the first time and set ourselves up to be future proof, which means just being organized, so then when you do have some hardship or you are struggling to try to master a particular topic, if you have a bunch of information on one or two topics stuffed in one category, you're able to quickly go back and give yourself a refresher on that. And it just makes life a whole lot easier, because there's already enough for us to try to drill down on and really get to, being good at, right? There's so many things to try to get good at. And if you're not organized, you make it really difficult for yourself. And it's already difficult. Everything's, trading's already a difficult thing. Why make it more stressful? Right? So yeah, this is something that hopefully makes you guys excited. The whole situation for bias has been correct from the interest rate markets all the way to the DXY into the S&P and the NASDAQ. Right? All of that, like I've said, has stemmed from this analysis. How price was going to seek highs in the bonds, and then how price was going to drop in the yields. That then sent reverberations through the DXY, which has basically given us basically just a tap into the internal range liquidity, which is the weekly fair value gap here, and is now on its happy, merry way to attack the highs, like we've been basically saying it's going to do for the last week and since last week. So the bias process that I've been showcasing to you guys has given us the ability to understand bias for a week or two, right? It's not just one day, although there's particular ways to get on track with every single day as well. Not that you will be right every day, but there's ways to frame those out as well, right? But the higher time frame helps you not get pulled around so much when you're looking at, say, the 1 minute chart, because you'll know, okay, well, this time frame is doing this, and it's the higher time frame, and then you layer the other markets together to create a picture, and then you have something that you can trust. So with like a drop in the DXY, right, with this big wick going lower, I have not once said that, oh, we're going to be bearish now probably in a couple weeks, right? Like, at least overall. right? It just hasn't been the case. And that same thing is happening here. We have one side that we're looking at, which has been bullishness in DXY, bullishness in the yields, bearishness in the bonds, which has then sent signals for bearishness in the indices. And we also had a framework for the market maker buy model in the DXY. And then that in turn brings us into the indices, which also had a market maker sell model in the same context. Right? We've mapped that out. We see this is the second stage distribution. We see this is the first stage accumulation, second stage accumulation, smart money reversal, and there was SMT at the highs. Right? And then price dropped here, first stage accumulation after the smart money reversal, second stage distribution in line with the accumulation phase that was over here. And that second stage distribution, as ICT says, is generally a fast-paced, one-sided move. As you can see, every single element that we've discussed has played out yet again. Right? So I hope that the things that, like the people that have been here the last couple of times, I already know that my private community knows what the vibes are, but I hope that the subscribers that I have and the people that do choose to graciously give me their time and lend me their ear, I hope you guys get the value from seeing how repeatable this is, and that it doesn't have to be overly complicated, right? But there are things that you need to build muscle memory behind. And you spend enough time here with me, like with my private community, you guys will start to catch on, and it'll become a whole lot more clear. Like it says in the bio of this channel, right? We're looking to take people from confusion to clarity. So that's the main goal. Anytime I have a call, anytime I have a video, that's the main goal, is to get people not confused, and then just to showcase how you need to operate, whether that's following your rules and then the realities of trading, to simplifying things that's taught in Smart Money, while not taking away from our awesome mentor, right? Or the overall mentor for many people, which is ICT. Right? Because that's where everything has come from. Yeah, so in terms of how could we potentially participate? Price has already moved. Do I sit here and think, oh my God, I missed the move, I'm never going to be able to get in another entry? No, we will sit and monitor what happens. Price is dropping lower, seeking the targets we've outlined. I already outlined the potential move here ahead of time. We talked about why this dropped, right? We've discussed the entire narrative for the last couple of weeks, and again have been extremely on point each and every day. But yeah, so we see how these up candles here, price came back after the retracement, which this was also a fair value gap, I think, on the 5 minute, right? Or it was on the 3 minute, huh? 2 minute? Yeah. The 2 minute offered this sell, but I said I would have wanted to wait, although that could have been an entry. When price got below this low, I said this order block here should hold if we're going to continue being bearish, if DXY continues to run higher. And then 50.39 was a target. What happened? Price respected the midpoint, so it gave us clarity that this is actually going to be doing the bearishness, right? It's going to continue to hold going lower. And then this was also offering an entry here as well. And then price now has come back. This here, this wick here, you see how price respected the midpoint of this wick? You see how price respected the midpoint of this wick here? When price is delivering to a particular direction, in this case bearish, you want to look at up wicks and the behavior that happens inside of those as price is printing lower, because they will act as premium arrays, right? And as you can see, if the midpoint is respected, just like how if the midpoint of this order block was respected, that signifies weakness. Well, if we look at up wicks being respected and the midpoints don't get attacked and price continues to drop off of that type of characteristic, right? Like leaving the midpoint, then we can trust the fact that we're really bearish, and even those can be potential entries at times. Like when you get some experience in monitoring this price delivery, you'll be able to visually see institutional order flow telling you a story. Like when price is printing, it's telling me a story. I know that the midpoint of this order block's been respected, so that's showing weakness. I know where there was SMT at the highs, so that showed potential cracking correlation to the downside with DXY going higher. That's telling me a story. As price is breaking through this order block, coming back, respecting midpoints of up wicks with an assumed bearish bias, that's telling me a story. That's all amplifying my trust. And then you add on the things that we've been discussing about the interest rates and everything else, the story becomes crystal clear. All right? So it's everything comes together, right? But you have to know what you're looking for. You know, if you're a hunter that goes out looking for animals, but you don't know what that what's the first thing you look for, you're not going to really have very good results in finding an opportunity. It's the same thing in the markets. If you don't know what the hell's going on, and you haven't, at least if you haven't had specific things shown to you, like for example the up wicks and the midpoints, most people don't even know that that's even a thing to observe. The up wicks and a down move can act as premium arrays. Like most people, that's went over their head. They never even thought of it, but it's been right there in their face. And you go back and back test what I just said, and back test everything that's been discussed, in all honesty. But something as simple as studying the wick relationship, you can see it happens over and over and over. The wicks, as price is moving to a particular direction, price respects those areas, and that's telling you a story. It's telling you part of the story. It's part of trying to get yourself to trust particular moves, particular directions, right? And if you're in a trade, this is a very helpful thing to observe in terms of identifying visually institutional order flow on top of the PD arrays and how those are respected as price breaks, in this case, to the downside. So our target has been fulfilled, by the way, yet again. So yeah, we've had this one entry here, which I didn't personally want to participate in. And then this one, as I stated earlier, also delivered beautifully. The reason I didn't take any entries is because I'm not in a rush this week. I've already made money, and I am patiently waiting for something to either present me with something better than this. It gives me more opportunity to have a larger move. I'm just taking it easy, right? If you make money, you don't want to. The worst thing you could do is make money and rush in to try to get more. Set your weekly goals. Once you hit those weekly goals or monthly goals, consider relaxing. Consider sharpening iron with your skill set, right? Versus being a fiend, trying to always be doing something live. But again, this played out. This one was a good, decent opportunity. And rules are rules, right? Oh, for sure. Yes, so I have Big Bulls. I have a link on my Instagram. I believe I also have a link in the description of the stream or the last couple streams. It tells you the link so you can go find more information about the access to my private group. There's definitely just go check that out and see which options fit what you're looking for. And yeah, I appreciate the interest. And yeah, I appreciate all 7 of you guys that are on this call with me, right? The whole goal, I'm not looking to be famous off of this stuff. I'm looking to impact, even if it was one person. There's already been hundreds already at this point that have been making a lot of progress. And it's super humbling to see how many that have come to me have either become funded or just been able to at least get themselves on the right track to achieve consistency and have the right mindset versus trying to be so obsessed with the get rich quick and all the crazy nonsense. Although that would be wonderful, obviously, to get rich quick, right? But it takes time, and you don't want to be reckless. So got to be a professional, So I appreciate your guys' time and your guys' willingness to come and see what I'm offering to the community. So yeah, I hope y'all been getting value. If you have been getting value, definitely if you could do me a favor and go like the video and maybe share it to anybody you think could benefit. I'd really appreciate it, and helps me get to more people, which is the whole goal. I'm trying to impact as many people as I can, because we live in some crazy freaking times. Okay, we got chaos going on, so we want to be able to have a tool that we can use to combat either inflation or a chaotic mess that's going on, right? But yeah. So yeah, since that target has been hit, let's try to observe where a further target can be. Okay, so let's actually go to let's go see, get on the 1 minute. What we can do is we can take this high here, go down to this low. We could start seeing some fib projections to see what further what further liquidity pools can be attacked that can line up with one of these fib extensions. So we could see that the 200 level has already been tackled. The idea that I pointed out here, the 5039 level, that was basically right before that 200, which is something I generally do anyway. If I have like the 200% or the 2 standard deviations or whatever that I'm trying to target for the swing projections, generally if I'm targeting, say this one, I will not look to capture the whole thing. I will literally just look to capture something a little bit closer, right? Because this whole move is not needed, right? Like, think about it. If you would have taken the entry I gave out earlier and were independent thinking and trusted and believed in the fact that we have been correct, and the logic just made sense to you, this was already 15 points? 20, it was like 20 points from this late entry. Right? Well, it's not late, right? It was just like one of the later entries because nothing was offered in here. But that's another 20-point position. So that now puts us at, in terms of the lives, that now puts us at damn near 13-0. Well, I did send one. Well, I talked about one with my private group that didn't work. So technically, it would be 12-1, right? In terms of the call out for the last 2 weeks, which that's pretty good if you ask me. But and many of them, mind you, there's 12 opportunities that were sent out, but I personally only took 4 of them, right? But all of them played out except one, because I have rules. I have things that I want to see, right? So any of the entries that I've given out, it's up to you to decide if that fits in with your model and the way that you view price action. If I call out a trade, say this isn't something you would have felt comfortable getting inside of, right? Then that's fine. That just means you didn't miss a move. But there's logic that makes this idea profitable, that is something that can be very beneficial to you with whatever model you choose to use. Because like the up wicks, how they act as premium arrays, how this consecutive up candles, once price got below that, this can act as an order block, right? And then the same thing here, these up candles can act as an order block. And you can see how that plays a role. And then price comes back, he uses the order block again, and also uses the midpoint of the wick. It doesn't even come to it. So what does that mean? Price is weak. As price is moving away, you want to keep these little nuances in mind because it's so powerful. Yo, all right, big bulls. I look forward to hearing from you, brother. But yeah, so I want to make sure. Do any of you guys have any questions? Do you need any clarification about something? Is there anything that I can provide you or provide to you of value in terms of maybe answering questions, or was there anything that was confusing? I definitely want to make sure that I'm here answering as many of the questions and getting in front of some of the roadblocks that any of you guys are facing, because that's the whole point and why I'm even on the internet at this point, because I could just be in my own world, not worried about anything. But things are rough, and I just want to give back because I've been blessed. So yo, what's up, Jonesy? What's up, Jonesy? So yeah, it's been freaking beautiful. All right, so we got this little fair value gap in here. Trying to see what we do, because look, so notice how we broke through the previous day's high, and what has happened now? Price purged out liquidity, and now after taking that liquidity, which is a external range liquidity, price ended up dropping lower, now seeking internal range liquidity. Right, we got equal lows here. So if we don't want to get stuck on the 1 minute. So again, just like I said about how this, when it's respecting the wicks, how price was moving, something, you take that information, you take it to here. You see this large down wick? Well, that large down wick, if you break it down into quarters, you'll see the midpoint. If we're going to stay really, really bullish, then it should respect the midpoint of this and continue going higher. If not, that could slow things down for the sell side delivery. Doesn't change anything, right? Only been here for an hour, and I've got to say this is gold. Yo, I really appreciate that. I appreciate that you feel like it's been some value. Because, man, I really do try to make things as simple as possible and, make it digestible and let you go away with something every single call that's going to be able to be applicable. Like every call that we've had so far on this YouTube channel that's been live has always had something spoken about that you can go into the chart and study. Like today, for example, it's the up wicks, and when price breaks through specific PD arrays as price is moving, you can look at those as potential order blocks. But what I really want you guys to do is focus on that wick idea. When price is moving in a particular direction, assuming you know what direction it's going to go, start to study how the wicks respond. Look at this right here. Remember I said watch the wick here. If it continues and doesn't break the midpoint, we have no reason to worry about price turning around on us, especially since the bias overall is bullish because we're working inside this weekly fair value gap delivery, right? So we should have no problem getting up above this high, unless of course price wants to consolidate. But this bias, the bias for this has been solid. The bias for this has been solid. So that's why the bias for this has also been solid, along with the DXY. Oh yeah, that's another thing to go and study and start applying, is the interest rate market analysis and how that works with within the grand scheme of things. I'm killing it in demo for the last 6 months. Okay. Now that I'm live trading, it ain't going so well. Yeah, and the reason that would be, brother, is because you have growing pains trying to get used to the psychological warfare that goes on when we switch from demo to live. And that's where all the things that I discuss on a continuous basis come into play. You got to have a strict set of rules that protect yourself, so you don't have to be worried if you get into an entry. You don't have to worry, oh my God, I'm going to lose. Well, you need to accept the fact that you are going to lose. There's, just like I told my boy Trey earlier, who basically had a 100% win rate, which, congratulations, brother, again. And he passes phase 1 and phase 2. When you have a lot of success in something like a demo, say you have a high win rate, or in any account, if you have a high win rate, or just go on a winning streak, you got to manage the highs as well as manage the lows. You can't get way up high thinking you're some hot shit, and you can't get way too low thinking that you're a miserable failure. You have to find that middle ground, and in all honesty, that is part of why this takes so long to learn, because you have to manage that inner conversation, and that takes time. It takes time to develop the understanding that losing is part of this game. It takes time to understand that although you will take losses, that doesn't define you as a trader. It takes time to realize that if you're going to be here for a long time, the losses you take today, as long as you manage your risk, they won't even matter, and it'll be like they never happened a year or 2 or 5 years down the line. So for us to try to sit and worry about the next trade and us taking a loss, basically beating ourselves up over that, if you think about it from what I've just said, it's pretty irrational for us to take a loss and beat ourselves up, as long as we're managing risk and doing things properly in a disciplined manner, right? It's just there's no reason to beat ourselves up. But again, that comes from you knowing the realities of what it is we do, having rules in place so you can trust yourself because the rules are there to help you, and being able to manage the highs and lows effectively, never letting yourself get too high, never letting yourself get too low. Like, yes, the last couple weeks and the last live calls, I have been pretty on point. Almost every single thing I've said has come to fruition, right? I can be thinking, oh, I'm some hot shit, or oh, I'm this and that, but that's totally irrelevant. You know what I mean? And that's a trap, because there's somebody out there that's always going to be better than you are. So your focus should be, what are my goals for my life? What are my goals with trading? Why am I even doing this? If it's to get famous, you probably you shouldn't do this, because you will get wrecked. Okay? If you got to change that mindset. If for anybody that has that type of goal to try to get famous off of trading, you have the skill set. It's by default going to be very noticeable, so you don't even have to try, right? So having the right intentions is also a beautiful way to be able to assist yourself in managing the highs and lows. The losses are the thing that make it hard, for sure. You got IY stop on? What does that mean, brother? Yeah, you gotta have if that's what you mean, you gotta have a stop on. You gotta have a stop constantly. Oh, you gotta stop. Okay, yeah. You want to make sure that you always have a stop loss. You want to make sure that you don't try to hit home runs all the time. You want to make sure that you're never breaking yourself, and all you got to do is just make sure that your risk is low. I tell my students to always have a 1 to 2 trade attempt rule on any given day, right? And so that means that if you're risking 1%, not saying that 1% is something everybody should use, because if you don't know what you're doing, you shouldn't even be risking 0.5%, because you're just, it's like not knowing how to drive a car, but you get in a Ferrari, like you have no idea what's happening, and there's no safety, like you have no idea what's going on, and you do it by yourself. Something bad can happen, right? It's the same with trading, right? If you don't have rules and specific things, you're setting yourself up to be in pain as a new trader, which will last you sometimes years and take you years to get over, when you can just be very, very strict and realize this is going to take a while to get good at. It's unrealistic to try to master something as technical as trading in 1 year. It's unrealistic. You have to understand yourself. You have to navigate the market conditions. You have to understand the model. You have to understand what validates and invalidates your bias and your trade setups. You have to understand risk management. You have to master your trade psychology. You have to know, and a laundry list of other things, fundamental analysis. There's just a laundry list of things. So if you think about it, trying to get rich quick off of it, or try to, master this within a year, as some people try to say for clickbait, right? It's just super negative. It's one of those negative things, to think about, because you're putting unrealistic expectations. And then if you don't hit those expectations, here comes the negativity. Oh, I'm a failure. I'm never going to get it. All these different things. And it's just unnecessary. There's no competition. Like, I'm not in any competition with nobody. I have my specific goals that have nothing to do with anybody else on this planet besides my family, right? I have nobody to impress except myself, the person I look at in the mirror every day, right? There's the only person I'm in competition with, and the only person that you should be in competition with, all of you guys, is the person and the trader that you were yesterday. Are you better than you were yesterday? That's the only competition. You may see me doing things and this and that. There's no competition, There's no competition at all, right? It's good to have things that you're aspiring to and things that you can get motivated by, right? But that motivation, a lot of times, and many people, turns into like a vicious competition within themselves, and then it acts as a barrier sometimes, right? So just remember, anybody you see on social media that's doing things, because you are your own person, you are your own trader, you can aspire to some results that you see. And if you're around someone like me who's trying to help you and help everybody get to those goals, that's a healthy thing to be able to do. Uh-oh. Hey, can you guys still see the stream? I'm sorry. Look, it's like doing this weird loading thing. Yo, could y'all give me a little confirmation real quick? Hope I'm not having no technical difficulties. Uh-oh. YouTube is not receiving enough video to maintain. What? Okay, for sure. Yeah, it's so weird. We're always under attack, yo. Like, my private community knows we're freaking always under attack. Freaking technology's always trying to fucking... Oh my god. But yeah, I kind of lost my train of thought now with this. But yeah, you want to make sure that you approach this from a realistic perspective, and you don't want to beat yourself up. You're not in competition with nobody. The only person you're in competition with is yourself. And that person should not be judgmental. You yourself, you shouldn't be super judgmental. Yes, have helpful criticism that can push you forward, but you can't be vicious to yourself, because it's just going to cause problems, right? Can you guys give me one more confirmation that everything's running smoothly? I appreciate it. I just want to make sure, because we're moving now into the open, and we have the silver bullet coming up, so I want to make sure that everything is clear. fine. Okay. I appreciate. Hey, what's your name, by the way, brother? I want to get rich. Me too. Oh yeah, and if you guys could let me know, where are you guys from? Right? I want to see what demographics we got going on. I know two or three of you guys are actually here in America. Actually, one is pretty close to me over here in California. So yeah, we got the opening range, by the way. Opening range has hit. So this was one of the entries. So let's save this entry. Put this in my private group real quick. Okay. All right. Ireland. Yo, that's freaking awesome. Yo, you know what I heard about Ireland? I heard that they are one of the most Christian countries, and they're also one of the richest countries on the planet. They're actually more financially well off. I guess from the list that I saw the other day, they're more financially well off than even America is in terms of debt. And, you know, yes, America has more GDP or whatever, but, you know, there's a ton of other issues. We're in debt. So technically, the richness is not actually real. It's just we're just massive, but these people are wasting our money. But yeah, Ireland, shit, I want to go to Ireland. That'd be freaking awesome, bro. How is it in Ireland? Like, it seems like it'd be pretty beautiful out there. I know Switzerland's pretty nice too. Yes, so again, so this looks like it literally just retraced. It's done exactly what we said the weekly range was probably going to do, which was at the start of the week was price potentially going higher to create a market maker sell model, which it absolutely did, presented the buy side of the curve up into the fair value gap, and then prices now drop lower, seeking the low here. And again, large wick, what do we do based on what we've talked about today? When you see a large wick, you break it down into quarters. You get your fib, break it down into quarters, and you could see potential targets. And then again, if we're going lower and price retraces back up, the up wicks, you measure those out, those act as premium arrays. You can see how these didn't really fully respect because price had another objective to reach into the inefficiency. But as price dropped here, I mean, you could even see on the daily chart, that same thing applies. It uses the wicks. The midpoint of the wick was respected. It aggressively pushed off. Midpoint of the wick wasn't even attacked. Price sold off. Right? So that's one of those really applicable things that I highly suggest you guys check out. Yes, so look at up candle, price retrace back into it, respected. Up candle, price retrace back into it slightly, but it more respected the fair value gap, and then it dropped. We have more up candles, price is now retracing back into it, and it looks like it's going to continue being heavy. And again, our target is this here. We also have this big wick here that can also be looked at as a target for NASDAQ. Same with this here, this wick here. For near-term targets, we have long-term, longer term, and then we also have the short term, which is the wicks and the inefficiencies and these previous days' lows. So as prices printing lower, yeah, the higher time frame draw on liquidity could be this low from the weekly time frame, but as you drop down into the lower time frames, you can start breaking things down further. Previous days highs, previous days low, previous session highs and lows. Previous weeks highs and lows, previous months highs and lows, London's high and low. Well, that's pretty much the previous session high and low. But yeah. And so as prices moving towards a higher time frame direction, it could be reaching for a number of things that can get you to be profitable. Like, for example, one of my favorite moves, or one of my favorite liquidity pools to target, is the oh my bad, I got distracted from the one of my favorite targets is the London's high and London's low, because generally that'll get attacked, right? Either it'll get attacked as a target, or it'll be utilized as a framework to set up something like a bearish power 3. Price would run, it could run above the highs, which would be London's highs, to pair up smart money orders to then go lower, and then sometimes attack the previous day's lows as well in the bearish scenario, hypothetically. Numbers lie. We have so many American. Oh no. Oh wow. Damn, dude, that sucks. That's kind of how it is in many things, huh? Things are just being ran to the floor, unfortunately. Well, that's awesome, bro. I'm definitely putting that on my list to go travel. I think that'd be a fun thing. So yeah, let's check and see. So yeah, we want to observe what price is going to do here. Are we going to take this high and then attempt to take the low? We don't want to see it come back to the midpoint of this fair value gap here if we're going to actually be bullish, right? And be able to trust it. My objective for the week has been hit, which was this weekly fair value gap. So depending on what it does here, well, I have my other larger target as well for the bonds, which has a little bit of room to go. But overall, the bias for this fair value gap has now been fulfilled. Let me go see. I'll check that out real quick for you. Oh, you're talking about this as the consolidation here? Talking about like this little area here? Right here? Oh, you're talking about 1 hour? Yeah, this here could be a potential smart money reversal here, definitely. I mean, you could even look at this here. This consolidation is also a smaller fractal presenting you with another one that could be within this larger one that you're pointing out on the 1 hour, right? So this consolidation can also be a market maker model going lower inside of the 1 hour market maker model. So yeah, as long as DXY can continue to go higher, I'm trusting in a lot of the shorts in many of these assets, whether it's currencies or whether it's the indices. But yeah, we want to see DXY basically hold. So yeah, we got the fair value gap down here. So we don't want to see this fair value gap get violated. Yeah, we should be able to see price hold. This is also the midnight open. For those of you that aren't familiar with Power 3, I would highly suggest you go check out my Power 3 content. I break down a lot of basic stuff. And then again, market maker content, I also have a video talking about market maker buy and sell models, because you're going to hear me talk about market maker buy and sell models all the time. It's literally like a pillar to my my approach, as well as Power 3, as well as breakers, right? Let me ask you guys this. What are your favorite models? Or what is your particular model you're looking to solidify right now, so I can kind of get a feel for where everybody's attention is at? Kind of help me also be able to solidify. And that's awesome, brother. Hey, if you're focused on market maker models, bro, you're definitely in the right place. I have so many things that I've taught. Of course, the things that I've taught, I have been able to soak up from, the mentor, right? Mr. Michael J. Huddleston. Unicorn. Are you talking about the breaker with the fair value gap? Is that what the unicorn is? There's a whole bunch of people saying this unicorn thing, and some have different concepts. But that's the breaker with the fair value gap, right? For the unicorn. Yeah, you're actually pretty right. But if you're talking about the breaker and the fair value gap as the unicorn pattern, the 2022 model pretty much can form, like I was talking about earlier. It could form inside of the breaker. So I mainly focus on indices, pretty much exclusively, but I used to trade GBP USD full time. But everything that I share and everything that ICT teaches, they're all the same. Yo, all right, brother. I'll see you later, Nico. Appreciate you hopping on as always. But yeah, in the private mentorship, we talked mainly about the indices. But as you can see, I pulled up the what is that? The GBP, and we were able to see and identify, things within seconds, because it's all basically the same. Price is price. There's only a little time difference when it comes to Forex in terms of kill zones and stuff like that. But other than that, everything's pretty much the same. Like literally, it's just a different name. And there's different news events that affect different things. So yeah, we're moving into the silver bullet time window. But as you can see, that move that I called out earlier is pretty awesome. I'm not comfortable with trading. You're not comfortable with trading 1 minute. You are 5 minute on the indices and 15 minute. See, so you saying that is a beautiful example of you being self-aware. Okay, and that's not a hindrance to you. That's not something that will make it harder for you. That's actually a good thing. So you're not comfortable with executing on the 1 minute? Am I understanding that correctly? Can you use 30 minutes for bias and then use silver bullet as entry model? So the thing is, bias, a trustworthy bias, like doing what we've done on the live calls, the last couple live calls, how the bias is able to be called consistently, that comes from my awareness of what the higher time frame's doing and the process I employ from getting the bias ideas from the higher time frame. So then when I go to the lower time frame, say like the 30 minute, like you're saying, I can trust exactly what that 30 minute is showing me. So you're always going to want to be able to use the weekly or the daily chart, develop a narrative around that, and then be able to find, like the 30-minute and then like the lower level time frames within that higher time frame. Because big banks and the people that actually run this business, they're not in the 1 minute time frame. They're making big moves on the higher time frame. So in order for us to have an easier chance of having consistency in terms of bias and direction, we have to derive those ideas from the higher time frame. ICT has said on a couple occasions that he spends more time on the higher time frame than he does executing on the lower time frame. And there's a reason for that, because you frame the narrative out and your navigation becomes a whole lot easier. Once you have your navigation process down, then you can start solidifying your bias and direction. Once you have your bias and direction, you can start focusing on specific liquidity pools. And then once you have those specific liquidity pools, you can then piece together an entry model that can get you in line with, attempting at profitability and consistency. I execute on 5-minute indices and 15-minute on Forex. Now, there's no issue with that, brother. There's really no issue. What I do suggest is that you don't trade anything other than the S&P, though. If you are going to trade the indices, I wouldn't trade anything other than the S&P. All right, guys, we are going into the silver bullet. Yeah, this was another beautiful move. It's just amazing to see. It's like a work of art. And to know that we have basically broke down why price should have done this, and hopefully I've been able to make it make sense to you guys of why it's moving the way it is and why we could trust the things that we've studied. I hope that that process is starting to make sense, at least the little elements, because we're going to go over this a bunch of times. I have some videos about bias on the YouTube channel. I have a lot of different videos, from execution examples to psychological and monetary risk management, all kinds of different things. But yeah, I hope this stuff has made sense. We'll probably be on for let's say like another hour or so. Probably after the silver bullet's done, just so we can kind of see, what else can be offered. So we're in the 650 macro right now, or what is that? The 950 macro, meaning that price should have a quick sudden move, and we can kind of see that it's basically done that. We have hit a new week opening gap. Again, remember I said this was going to be likely a low resistance, fast-paced move, given the fact that it is in the second stage distribution of this price structure that we've outlined as a market maker sell model, right? So for those that need more visual, this would be the original consolidation. First stage accumulation here. Okay. And then we had the second stage accumulation here. And then you drag that over, and we can see how that turns into the first stage distribution, and then the second stage distribution turning into a low resistance liquidity run. And we can see how that beautifully came to fruition. All right. I can't remember what that box is. Is that an inversion fair value gap, I think? Yeah. Okay. Yeah, I would have really honestly liked for this to have done like what it's doing here. You see how this is here? So the NASDAQ is something that I'm going to consider. I'll probably consider taking a NASDAQ trade coming up. Potentially this inversion fair value gap, or potentially this fair value gap up here. All right, so let's sit and study what this is going to do. Price has sold off pretty aggressively, so it could look to retrace, right? Which is why, you know, price has already delivered. We have basically ran stops, shifted market structure here, and now returned back to a fair value gap. And this is also an inversion fair value gap. So this, you know, if we're heavy enough, could be a good opportunity to get back in line because of the model rules. But that really just also depends on what the DXY is going to do, because DXY has already taken a significant high. So it wouldn't be unreasonable for this to want to retrace. But that would then make this want to retrace higher as well. Right? So given the fact that DXY is doing what it's doing, I would have missed this opportunity. I would sit and have to wait. We do have SMT here, right? Between this high and this high. All right, so what factors make it so me seeing this opportunity, what keeps me out of something like this? Well, when we are extremely one-sided, we basically run the risk of the retracement occurring. And of course, it could reach into here and still drop, right? But the risk versus the reward has to be measured out. And whether your model is in the market or not has to be reasoned with in order for you to, you know, weigh out the odds. Like, you know, again, this could deliver. Am I willing to take the risk? That's the question you'd have to ask yourself, right? But if your model is in play, right? If you see it in play, you either study it, especially if you're not taking live trades at all, like you don't just go in there winging it. But if you have your model and you know what you're looking for, if the model presents itself, either you can take the trade, accepting the fact that there still could be a risk of price retracing, or you could sit back and wait and observe and let it print more. These consecutive up candles here, if price gets below that, that's another potential opportunity to enter. So again, when you see an opportunity take place, sometimes you need more information to be able to trust further. Like this, price has been accelerating aggressively. So in my opinion, I would like to see a little more evidence showing that it's going to still continue. Because, I mean, it's already sold off. We're still inside, though. You got to consider, we're still inside the heavy second stage distribution. So that could be a reason why this doesn't want to retrace back, because it's still not completing its second stage distribution yet until it gets down below this low. Here. Right? So we still have a little bit of distance. Right? And so that would be a reason why this doesn't go up there. So that could be a reason for you to put in your journal why you could trust this opportunity. But then you can also add in the fact that we have been very bearish already, and we still run the risk of price retracing to do what? To get price into some form of a near-term premium price level to then continue selling because nothing has changed. So yeah, price breaking down below this low here, that will become a order block. Okay, right here at this candle here, or this line there. That is, in my opinion, a potential entry to get back in line with the price delivery. Right? So that is my observations for what we see currently. And then NASDAQ can go all the way to 17,290. And again, the second stage distribution characteristic, if that holds and continues, this is, in my opinion, trustworthy. This is not financial advice. I'm not here to get you in trades or anything of that matter. This is all educational purposes only. Whatever risk you incur is your own responsibility. Whatever wins you participate in as well, they're also your responsibility, and I don't take any credit for that. You do. Right? So consider everything that I have said in terms of what is happening, and either observe or do what you will with the information. So one thing to consider as well, we have this as an order block, we have this high, and we have this high. If price, and we also have this inversion fair value gap. So if price gets above those levels, if it breaks above this high, the trade's dead. You don't want to participate and continue. So that would be invalidation. But again, an opportunity was given here. Well, I mean, this in the S&P, the opportunity was up in here. But you look at the NASDAQ, they're really correlated in many ways. So essentially that's, generally going to translate to the other indices too. When there's an entry in one, it's likely going to be in the other ones as well. But yeah, this here has an SMT at the highs here too, which is another factor that could be considered in terms of building trust for this opportunity. And again, if there was an entry taken here or if there was one taken here, what invalidates the move? Well, if DXY turns around and falls deeply, starts attacking the sell side stronger, that would be a problem, right? You also want to consider, is that stop too big for a NASDAQ trade, right? If it is, then and it's outside of your rules, then you wouldn't want to consider it, right? Or you'd have to wait, just wait and see, or you'd have to drop your risk enough to the point where it's not going to put you above your risk percentage. And again, if you're trading, if you're trading like within the NASDAQ, you want to make sure that, especially in the NASDAQ, you're not making risks over 0.5%. Right? Again, there is a risk of price running back, like I said, right? So yeah, we'll see. And the target essentially, logically, would be here in terms of reasonable target. But in reality, since price has already taken off, if I was participating in the move, I would have, been happy with it coming down here. But as we can see, price has done the scenario where it wants to retrace a little bit and come back and seek more stops. Does this change the overall bias? I mean, it's also Thursday, so you do want to consider the fact that there is a possibility for, since price has been super bearish, and the weekly range has been bearish, price does have the chance to turn back into the weekly range and start pressurizing people that are selling and their stops, in terms of a Thursday or Friday reversal, given the fact that I believe we're tapping into some form of a discount array. So I mean, it hit this fair value gap here. This is an order block. It's consecutive down candles. And if we look at it from this perspective, I mean, price is kind of somewhat range bound. Right, it's kind of just back and forth. We did have this heavy range move. So large ranges bring small ranges, and small ranges bring large ranges. That's something that ICT learned from Larry Williams. So that's also some of the deeper context to consider as well, when you're looking at price after a large range expansion. It could retrace, like we anticipated the retracement, and then off that retracement going into some form of a premium, which is kind of what we're looking at on the lower time frame too, right? It went from a discount, now it's reaching back up to a premium. And again, like I said, if this high was to be taken, that would have been the invalidation. Why? Why would that be the invalidation? Because when 3 PD arrays are broken, generally, like in this case, if you're in a cell, if 3 PD arrays to the upside get broken, generally you're going to be incorrect, at least for that current idea. Okay? So entering here, that would have been the second loss in the last 3 weeks, if that was an entry that was participated in. Whoops. So, what could price be reaching back for? Well, if we go from this high to this low, where's our equilibrium? Why is equilibrium important? Well, that would be a premium. That'd be a premium price level, right? So buy low, sell high, right? We discussed this in the last call. If you're looking to sell high, selling high is above some type of buy-side liquidity or inside of some type of premium, right? Which is above equilibrium. What PD array is above equilibrium? Well, if we're looking at this current range, we see that this order block here is in a premium, right? Let's look at these lows also. This is something that we haven't done yet. Look at these lows. Do you see SMT between those lows? The Dow made lower lows. The NQ made a higher low. So this means that the NQ is the stronger indice out of the 3 that we're looking at here. And you can see that translating into how price's reaction is happening as price is trying to move to the upside, seeking premium, right? The NASDAQ is the only one that has created higher highs here. So in reality, because that's the case, I should have seen that in this move. So not seeing that led to this example going against us, because I basically, in context, would have tried to sell the stronger asset, which is not what you want to do. You want to buy the stronger asset if we're bullish. You want to sell the weaker asset between correlated pairs or assets. You want to sell the weaker asset, which in this case would be either the S&P or the Dow, because clearly they're just, dropping off the face of the earth. Does that mean that NASDAQ will not continue to sell if we are going to still be bearish? No, that just means that the NASDAQ is going to be a little more difficult. It may not move, or it may be the slow lagger pair or lagger asset between the 3. So using SMT is very important in terms of measuring relative strength between correlated assets. So the SMT logic is something pretty useful. We could do a whole conversation about that as well. But nonetheless, if this was something that was taken, right, the win from earlier that was given would have outlasted this. And because of the rule that I shared earlier in terms of the 2 trade rule, so you only basically take 2 trades in a day max, because that manages risk. And then if you take a loss, you'd basically lower your next trade's risk management. So if you risk, like, to make it easy, if you risked 1%, your next trade, if you took a loss, the trade you take after that second trade would be at half the risk. Not only does that lower your risk amount and minimize the risk that you expose yourself to, it also saves the profit that was made if the first trade was a winner like today's was. And then it also makes sure that you never breach or have a horrible day that's hard to make back. And again, you're saving profit, because the whole point of this game is not to make big wins just to make big wins, but then blow it all and give it all back. The whole point is how much money can you keep versus how many trades you can be right in, right? It's not about how many times you could be right. It's about how much money you can make and how much you can keep. Because someone could have a $10,000 day, but then the next day blow it all. So did that $10,000 day really matter? No, because they basically blew the positive trying to seek more, which is becoming a victim of greed. And greediness does not survive in this industry. So we can also see how now price didn't want to continue. We've now become kind of range bound inside the DXY, which then led to us stopping the super heaviness that we've experienced pretty much all morning. So yeah. And if you're using the YouTube model, we basically didn't even get a chance to see anything for a counter trend buy. This buy would be put in the context of a Thursday reversal profile. And then of course, like I said, it's seeking a premium. So what I want us to do here is I want us to study what happens when price comes up here. If DXY comes down, seeks this sell side, sweeps this out, then aggressively moves higher, then we may not be done with price continuing to go lower for the rest of the week, right? But again, price has been extremely bearish. We've technically in the S&P, I believe we have fulfilled the market maker. Well, we almost fulfilled the market maker sell model. It looks like we're going to be due for one more retracement. It has already taken out sell side liquidity, right? So it's kind of stalled out. We've also hit the new week opening gap from February. That's basically acted as a support level, right? So again, that move earlier basically smashed the shit out of the market. And another thing we also have is these equal highs here. So what's resting above there? That's buy stops from all these people that were winning. So it's not unreasonable considering we saw SMT at the lows here, right? This continued to fall lower, showing that this is one of the weaker assets between the three. And this is showing that the NASDAQ is the stronger one. So in turn, that has basically given us a more projected move to the upside in this retracement. Right? So if you were trying to frame out an idea, maybe you're a counter trend trader. Maybe you don't like taking the trend. You like to see when it turns around. Well, price only does two patterns when it looks to change direction. Right? The only two patterns that it does is a failure swing like this at a particular sell side liquidity level, which we've already kind of purged out some sell side liquidity, or it's going to make that lower low characteristic, right, which presents an SMT between correlated assets. So that right there shows you, okay, we could potentially turn around. And you validate if there's like SMT at the highs and there's SMT at the lows at any given moment. How do you know which one to trust? Well, it's very simple. You look at what the DXY is showing you. So if there's SMT at the highs, but there's also SMT at the lows between these three indices, you go to the DXY to give you clarity as far as which one should be trusted. And generally, that gives you a really clear answer as far as which one you should trust. Oh, whoops, my bad. I just seen your guys's messages. Got kind of carried away. Oh yeah, see? That's another mistake. I did not consider this other news. I didn't even consider that was another news. So is an SMT basically a failed? Yeah, so an SMT is pretty much a crack in correlation. So if in correlated assets. So if, like for example, what we looked at with the Nasdaq, where is it? It's right here. So like for example, the S&P made a lower low, but the NASDAQ made a higher low, right? And it basically is important. S&P is not important when it's in random areas. It's important when it's at, for like, say like a liquidity level, like some form of a higher low, at some form of a premium or discount array, like an order block for a value gap, so on and so forth. When it's in those areas, that can help you also understand whether some level is going to hold or not. Like for a turtle soup, for example, how could you have trusted this turtle soup? Well, if it's at a discount array, right here, if it's at a discount array or inside of a liquidity pool, and there's a crack in correlation between this asset and say the S&P, right? And if it logically makes sense for something to retrace, like for example, we've been really bearish, so this isn't a surprise, right? If that's the case, then you can go start to trust the turtle soup entries, right? But yes, a SMT is basically a crack in correlation between correlated assets at a particular level in price action, right? So in this case, it had a failure swing, right? So this run higher, think about the psychology of what's happening here. It's been really, really bearish. They slam price lower. DXY has raged higher, looking like it wants to go higher still, as it's been doing for basically the whole week, just blasting off. What kind of dug lower to go higher, and now it's coming back lower. But nonetheless, right, they're coming back on the people that have been winning. Right? All these people that have been making money selling, right? Like even this idea, if I was greedy, right, if I was in this entry and I was greedy and couldn't take the 100 points, pretty much that was offered, exactly 100 points, actually. If I was greedy, then it would have came back on them. And there's people that are doing that exact thing. They're holding on to the trade for dear life, right? Thinking that it's going to run off the face of the earth, versus actually having a professional mindset and thinking, maybe I should just take what the market's giving me and just go sideline, right? So yeah, I hope I answered your question about the SMT. It's a lot more simple than many people make it. You know, it has to do with correlated assets. For example, like even with Forex, the GBP USD and the Euro USD, if there's a crack in correlation there, and then you merge that with what the DXY is doing, you can also find a crack in correlation with the like the GBP USD and the DXY, right? There can also be an SMT there as well, right? Like say the DXY made a higher high, but the Euro USD made a higher low. That's a crack in correlation, because if the DXY was making higher highs and basically took out liquidity, then the Euro, since it's reverse correlated, should take out sell side liquidity. But if it's failing, here, let me actually do a visual of that. So say this is the DXY. Well, since this buy side was taken and the DXY and the Euro USD are pretty much reverse correlated and they should move lockstep, then that means that the Euro should have done something like this too and then turned, right? If it was going to turn. But if that doesn't happen and price does this in the Euro, that's a crack in correlation. Euro failed to break through the sell side liquidity, but the DXY has made the run on stops, right? So that's a crack in correlation too, that generally can lead to something like this reversing, right? Going like this and then DXY turning around like that. But before that actual move happens, if you're able to get in front of this type of price delivery and you can see it, then you can anticipate, especially if we're at like a discount array for Euro and we're busting through and above this high was a premium array that we can reasonably anticipate a sell-off from, right? In that scenario, you can get ahead of the move and basically be pretty accurate in terms of whether price is going to actually turn around for the DXY, and then actually turn around for the euro or even the GBP. And generally, the euro would do something like this, and then the GBP would do something like this, right? And the one that basically took out the sell side liquidity in that case, this goes back to the relative strength, right? If this was Euro USD and this was GBP and this was the DXY, that's a cracking correlation across the board, not only between the DXY and the euro, but we'd also have a SMT, a bullish SMT from the GBP and the Euro USD as well. And then which one would you want to take if you're using that trio of assets between the DXY and the two currencies? Well, if you're looking to buy, this failure to get down below this low is showing strength. Just like this had the failure swing here, but the S&P and the Dow had lower lows. That's showing that the Dow and the S&P are the weaker of the three assets. So you can see that NASDAQ was a lot more excited to the upside in this retracement versus the other two, right? Like, look, yeah, I mean, you could visually see that here, right? So that's how SMT is helpful for relative strength analysis. And again, there's only two ways that price is going to turn. There's only two patterns. It's only this type of run, which is basically just a run on stops, then it shifts market structure, right? Or it's a failure swing, which then this candle here, this up candle here, if this was the case, that would be like that's a mitigation block. While this up candle in this swing would be a breaker. So that's also the difference between mitigation blocks and breakers as well in the same like example, I guess you could say. Does that stuff make sense, you guys? What I just said is a topic that a lot of people get super confused on. So I hope I was able to bring some clarity with those topics. Whoops. Yeah, I appreciate y'all hanging out with me this long. It's been like freaking 2 hours. So I appreciate you guys spending your time with me. Do you treat mitigation blocks just like... Wait. It blocks entry just like a breaker entry? Yeah, very, very similar. It's just the delivery looks a little bit different. So you basically see something like this, right? So technically the difference between a breaker and a mitigation block is just this run on stops. And then a failure swing here would make this, it'd make the down candle, at least in like a bearish example, this last down candle down here, or the consecutive down candles, generally that's where price is going to retrace into and then offer the actual breaker entry. But then if you have like a mitigation block, something like this, it's the same thing, except the difference is the swing above the high or the liquidity, the mitigation block fails to do so, but you still use the same principle of entry. And then of course, between correlated assets, you know, maybe NASDAQ does this, right? Creates the run on stops at the highs, and then maybe the S&P does something like this. So given what we've talked about, which one, if this was the NASDAQ and this was the S&P, which one would be the weaker one out of those two? If this was the entry that you were trying to take, would it be the S&P or the NASDAQ? Remember, the S&P is like this, and the NASDAQ would be like this. Exactly. because of the failure to get above that high, that's signifying weakness between those correlated assets. Exactly. And then, of course, you flip it up like over for bullishness, the same exact principle, just switched. So the one that makes the failure to get down below the low is the stronger one if we're looking to buy, versus the one that takes out the sell side, which is signifying more weakness. Right? And then again, that doesn't mean that the weaker one isn't going to move and that you can't like take that entry if you wanted to. But why would you try to buy something that is weaker than the other asset that's pretty much correlated, right? It's, you'd have to just, have to adjust in that way. Again, that's another one of those things that most people don't learn to trust until they go through the experience. But I hope that, what we've just discussed here was clear enough to now have you guys be able to go and confidently start dissecting this type of this topic, in your back testing. And one thing also to keep in mind, whenever you learn a new topic or a new pattern or whatever the case may be, you don't just go into the market right away and start demo trading, especially not live trading, right? Like you need to give yourself like a month or two or more to be able to solidify. Because like the 4 models that I have, like I took 6 months minimum for all of them, right? Studying only one at a time for 6 months. Okay? Because if you don't do that, you're not going to be able to get a realistic statistical gauge on whether something is actually efficient for you to use or not, or if it even makes sense. Like if you're trying to study, does breakers work, but you just keep taking the YouTube model and you're trying to figure out the breaker, but you keep seeing the YouTube model and you're not only focusing on the breaker so you can study that effectively, you're not going to effectively build that skill set for that specific aspect of things. So you want to focus on, just like what we talked about with the SMT logic that we just broke down. Right? You make a section in your journal and only look for SMT. Right? Keep in mind liquidity that gets taken. Like you gotta keep in mind where the positioning is at. You can't just take a random SMT. Right? Although sometimes, maybe there'll be a SMT in something like this. Maybe this made a lower high, but then or maybe this made a lower high here, like in the NASDAQ, and then maybe the S&P ran above the high. Well, that would signify what? That would signify that the S&P is stronger in that case. But you don't want to, that's something you consider, right? You can consider it, but generally you want to make sure that you're taking the the SMT logic and applying it in significant areas, so then the reaction from those areas is actually meaningful, and not just like super short term in nature, right? And again, it can be used like I just discussed, right? Like this can be like this, and then the S&P can break the high, but then that would just show you, just like we talked about over here, that would show you that the S&P is stronger because it broke through the buy side liquidity, versus the NASDAQ that created a failure swing and didn't even have enough strength to get above there. Right? So this is like it's a pretty important aspect of navigation and price and like validation, stuff like that. Right? Just a another example of the little intricacies that are in price delivery that will they take a little bit of time to add to your arsenal. But I'm telling you, you spend the time, you spend quality time digging into this type of stuff and doing, everything separated, you'll eventually see how everything comes together. And then you'll have a pretty strong repertoire of weapons and a lot of reasons to go about trusting yourself as an analyst as you walk forward and build up more experience. Right? So yeah, So yeah, do you guys have any questions about some of the stuff that we've talked about? I hope I've been able to um, bring at least some clarity, and I basically have given you guys another actionable step from SMT to mitigation blocks and breakers to when price is delivering as you're managing the trade. Something you could look at is the wicks and see how the up wicks are respected in down moves and how the down wicks are respected in up moves. Right, like for example, like this. Right, you can see, right, there was no wick. Right, this consecutive down candles here acted as an order block. So price came down into that and continued to go higher, seeking. Oh, whoops! These consecutive down candles here acted as an order block. Right, so that's another reason once it broke above this high that this idea wasn't going to be trusted anymore, at least for that time. And price ran, and you could just see all the wicks. Look at the wicks, how it did it. How it used that logic we just talked about. Respected, 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 and then just continue going higher. Those are all little signatures of institutional order flow showing that we're not going to try to go lower at this moment. So then you don't press upon trying to force the sell because, I took a loss here. Let me, I think it's still going to sell. No, you have to let price speak to you. There's a story it's telling you, but you have to understand the language, and it takes a little bit of time to, solidify that language. Clarified a lot of things that was confused about, especially as okay, for sure. I'm grateful that I was able to do that for you, brother. It's the least I could do for you spending this much time with me today when you could be doing anything else. So I greatly appreciate you as well. So yeah, now, like I said earlier, nothing has changed in the overall grand scheme of things, right? So this retracement did what? It came all the way back to a premium array. Basically, it hit the optimal trade entry level as well, right? And all the other assets, the other indices are looking like they're going to continue dropping, right? So now we look and see. So buy side's been taken here. If DXY now turns around, we have buy side that's been taken. We have a shift in market structure here, right? So we can consider if price is going to want to continue to seek lower prices, we can consider this as a potential area of interest if price was to retrace. We also have now this inversion fair value gap in here. But again, it's Thursday. Going into Thursday and Friday, when price has been one-sided the whole week, we run the risk of price wanting to pull back into the range to cap off the weekly range, right? And basically go against anybody that's been making money. So again, if a trade was to be taken in this fashion, you got to keep in mind that there is a risk of it not working out, and you have to accept that, right? And if DXY continues to dump off the face of the earth, right, if it just doesn't stop here, this is like the last line of defense. All this stuff is already a red flag for a continued upside move. The heavier that it keeps showing us, the less likely it is that this is going to hold and continue to go lower. And the more likely it is that the retracement can get a little deeper into the buy side liquidity, right? So DXY is a gauge. It's a really, really good forward-looking indicator. And I mean, you could even look at this as a shift in market structure with SMT at the lows, and then price still has a little ways to go to get up into a deeper premium. Right, so this here can very easily, especially if it breaks through this fair value gap, if this is to be trusted, it would need to stay below this fair value gap. Once it breaks out of that fair value gap, I'm uninterested. If I was to participate or even consider participating in a sell. So yeah, it's like some of the thought process, and just for completeness sake, in terms of my personal engagements and whether I would take this trade or not, I personally would not. I've given 2 of the main trades that I would have wanted to take, and one ended up in a loss, one ended up in a pretty smashing win. So if this was like something that was engaged upon today, I would basically now be in a position to preserve capital, and because I've made a decent amount this month, or this month plus this week, there's really no reason to try to push and have that mindset that every one of us has at the very beginning, which is like, oh, I need to trade more because I'll make more money. No, you're adding more stress to yourself, you're adding more risk to yourself, and you could basically be giving away money that's unnecessarily needing to be given away, right? But again, just because I'm saying I wouldn't take it doesn't mean that the framework here won't work out, right? It's just showcasing rules and the mindsets that I employ, so then you can, take the thought process and kind of reflect on it. And again, if DXY was to blast higher and then give us a shift here, breaking above this swing high, and then looking like it wants to basically hold, and then if we see like this basically continue to rally, then I would be a little more confident, right? And then I would be, okay, yeah, maybe I would. If I didn't take a trade at all today, and this is all I was looking at, that would basically permit me to think, okay, maybe we are not done. But we have actually hit the weekly target that I had for the yields. So this bullish week already can very easily look to retrace now, because we've hit a premium array on Thursday or Friday. See, when we have reversals in the week after price has been one-sided, those reversals generally happen when price on the weekly perspective or even daily time frame hits a higher time frame PD array. In this case, the PD array would be the premium weekly fair value gap. So because we've ran into that, given the day that it is, being Thursday and or Friday, right? Doesn't matter which one of the days it happens. On one of those days, if that scenario takes place, you can anticipate TGIF or a Thursday reversal profile, right? Does that make sense, you guys? It's kind of like assistance in when you can anticipate when the week's trend can reverse, is when it hits a higher time frame PD array after price has been one-sided. If it hits it on the higher time frame going into Thursday or Friday, generally that's when price can be anticipated to reverse, and that's when you can even frame counter trend ideas, right? In this case, that counter trend idea would be the potential buy, right? But again, we want to observe, what we basically outlined here, and see how that holds. If this breaks through this fair value gap, right, and DXY continues to fall, then we could potentially not be done yet, and then maybe tomorrow would present an actual deeper buy side retracement. Right, so those are just some like hypothetical situations. And again, if this was something someone decided to trust, the invalidation would be breaking through this little swing high, this fair value gap, and then also this order block if the midpoint is broken, because that would make it 3 PD arrays getting violated to the upside, which generally invalidates an idea. So again, we want to also now remember the wicks. Let's see how this wick here, you see how this candle opened, all it wanted to do was press into the wick and then continue dropping, right? Yes, some of these other ones got violated, but why? Because it had an inefficiency to reach into, right? So inefficiencies hold more value than wicks, right? And so if I was to enter this entry, if I did enter, what would my targeting be? Well, considering we're already really aggressively, slamming lower, given that it's Thursday or Friday, given that, you know, we've basically called out multiple moves and are basically profitable for the week, I would not be looking for home runs. We do want to consider the fact that now we see DXY turning around pretty aggressively. We do want to consider the fact that we still do have a higher time frame target that could still be met, which is the low of the market maker model framework that we've had the whole week. All right, so again, the bias has not changed overall. Inside the weekly range and inside those weekly assumptions in terms of bias, inside those thought processes, sometimes things and circumstances can turn price short term. Like, you know, for example, what we've just seen. Price short term rallied up just to take out stops. DXY has also done something similar, has retraced. We have this, what the hell? We have this this wick here too that, we have this big wick here that we can also measure out, right? This fair value gap and the quarter point or midpoint of this wick, those are the last stands for prices, buy side run in this current range. So when those things start to get disrespected, you know, that's when red flags pop up, right? This deep retracement is also showing that, okay, price is definitely slowing down, and we've taken some stops here and we've been pretty bullish for the week, right? So all these things have to be put into consideration when you're looking to make decisions, especially since price has been very one-sided. We have delivered a whole bunch of sell-side liquidity already, right? So what they're doing, they've pulled price back, came back to a premium, and we have to observe what DXY is going to do. And then, like I said, the fact that the interest rate markets have also hit a higher time frame level, these are very influential, right? So if this buy side delivery ends up like stopping or slowing down now, that sends reverberations through the DXY, right? So if the yields decide that they now want to try to retrace after they've hit this higher time frame premium array, that's going to basically make it hard for DXY to continue aggressively pressing higher, right? And then of course that sends reverberations into the indices, right? So these are all just thought processes that I'm sharing with you guys. Trading isn't, you don't got to think of like a million things at once as a trader. I'm just like breaking down the landscape for you guys and just giving you some of my thoughts of what we see in price. And again, we're still sticking to overall, we're still sticking to our overall bias. But near term, given the conditions that we're in, with what I've just discussed with the interest rates, with what I've also discussed in terms of like the day of the week, how it's Thursday or Friday, generally, if we hit a higher time frame premium array, whether that's a liquidity pool or a PD array, if we press into it on one of those days, generally some stuff like this occurs. And then, of course, the SMT also at the lows here, kind of made it show itself that it's going to slow down. And we can see how it's slowed down. So let's take a look at these highs here. Let's take a look at these highs here. Okay, right there. Let's go take a look at the... Okay, so there's SMT still at this larger range. All right, so here got SMT here. What's this one? So April 25th. April 25th. So yeah, it's like right here. So we got SMT here, right? Because the Dow made the lower high. So the Dow is the weakest one out of all of these. But again, bearish SMT gets validated by confirmation from the DXY. Okay, so if the DXY is not helping confirm, right? We have to keep that in consideration. Again, we are overall inside that larger time frame market maker sell model. So that has not changed overall. But again, near term, right? Since the interest rate markets are also slowing down right now because they've already hit their weekly objective, right? That could make us not want to continue aggressively seeking sell side, at least, for the current time that we're dealing with right now. But again, remember what I said about the wicks. We're watching the wicks. Let's watch the wick. We have an inversion fair value gap here. Prices dug lower. The red flag for sells to either continue or not, right? In this case, potentially not continuing would have to be with the DXY. If the DXY is selling off, the relationships that these markets have with each other have to be taken into consideration. That's basically called risk on and risk off. I have something very helpful I want you guys to take a screenshot of, if you don't mind doing so. I'm gonna pull this up real quick from the mentorship. So I want you to take a screenshot of this here. This is basically classified as the risk on, risk off conditional checklist, I guess you could say, right? So this tells you if the DXY is doing something, if the yields are doing something, what should happen to the other assets. That means commodities, stocks, or currencies related to the DXY, right? So take a second and screenshot that because this is a very important, or you could just write it down, do whatever you must. But this is extremely important. Like if the DXY is bullish, what do we want to see happening to confirm that, right? You can see that the DXY, if it's bullish, we need the bond yields to be bullish. The T notes, right, or the T note needs to be bearish, and the T bonds. Those are pretty much the same thing, right? It's the T bond view. I'll pull it up and so I could show you guys. The T note and T bonds are pretty much the same. They're just the T note situation. The T bonds are pretty much all T notes, right? And they're correlated with each other. So if we're bullish on the DXY, we want to see the bond yields bullish and the T notes and T bonds being bearish. And then of course with bearishness for the DXY, we need the bond yields to be bearish. The T note and T bonds should be bullish. Okay, so I hope you guys took a second to screenshot that. And so now let's go look at the T bond. And so the T note, right? The T note is here. Right, and then of course the T bond is referring to the 30 years. So this is 30 years, basically T bond, T note, whatever. Use it interchangeably. And then of course the T note is a 10-year, and we also have a 5-year T note as well. Right, and then you can, between those three, you can actually look at the highs. And you could even observe where there's potential SMT, because then that would also assist you in knowing whether it's going to go lower or go higher. If there's a crack in correlation between those three as well. I don't want to get too much in the weeds with that. We've already discussed a whole lot today. But we can do a deep dive on that as well if you guys would like that eventually. But yeah, the T bond and T notes are these markets here. They're basically doing the same thing. They're like correlated. But these are reverse correlated to the DXY price delivery, while the yields are pretty much things that dictate, where price is going to go for the DXY, which then, of course, impacts these other assets related to the US dollar. See, so now we have the yields looking like they want to retrace. At least for now, and we also see how the T bonds are also giving a little retracement here. What's that doing with the DXY? Well, DXY is retraced off the heels of seeing what we've just seen. What shortcut key are you using to change the symbol for just one pane? Well, when I have the 3 loaded up here, all I do is click on the one that I want to adjust, and I push down or I push up on the keypad. But what you want to make sure you're doing also in terms of like the setup, you want to make sure that the interval is the same, crosshair and time are the same, but you don't want to have the same symbol checked, and you don't want to have the data range checked either. So that lets these things freely get adjusted on their own when you try to manipulate them. But you want to make sure that you're clicking on the window that you're trying to adjust, or the asset you're trying to adjust, because if you don't, you're just going to adjust whatever you last clicked on, right? So the one that you want to adjust individually, click on it and then just push the up or down arrow. So yeah, we can see how the wick here, right, from the fair value gap here, price took out buy stops, has SMT at the highs, price fell lower, prices returned to this fair value gap. So technically this here is a YouTube model entry because all the elements are there, run on stops. We have SMT as well. DXY is now made a failure swing. So let's go observe this failure swing here. So we have a higher low that was created inside of this fair value gap. So then if we go to the euro, right, do you see the crack and correlation there? How DXY made a higher low? DXY made a higher low while the euro made a high, or the GBP made a higher high. Since the DXY made a higher low, which is a failure swing, GBP should have made a lower high if it's going to follow DXY. But there's that crack and correlation, right? They'd also had a crack and correlation between the euro and the GBP. So, as a result, at that higher time frame discount array, right, as a result, price is now turned, which is now given the ability for the indices to now continue seeking sell side, right? So again, it came back. What did it do? It just came back to take out the buy stops. Price retraced into this fair value gap and now has sold off and now started reaching for the lows. And DXY is now running higher. So what's another thing as price is moving? Again, we want to look at the wicks. Right? The midpoint of the wick was respected beautifully. Right? That's not random. That's 100% algorithmic, and it's one of those things that's in your face that most people are just not aware of when it comes to watching price and letting it speak to you and understanding the language that it speaks. So again, now we also have something sitting here, which is an order block. So this order block may potentially hold. If this order block's midpoint and this high breaks, then I wouldn't even want to consider. So if an entry was taken from this order block, because maybe you missed this entry here, once it broke down below and created this order block, well, if you wanted to enter there, your stop would go above the midpoint of this order block, and then you would seek either this low or this low, or 10 points, right? If you're trying to use the the lowest threshold, right, and aim for the stuff that ICT has spoke on in terms of catching 5 points in the S&P or 10 points in the NASDAQ, or 10, I think he said 20 actually for the NASDAQ. 5 points in the S&P or 10 to 20 in the NASDAQ for the low threshold, yet still able to be profitable type of targeting. So if that was the case, this entry here at that order block would have been already fulfilled. 20 points was already secured. If you would have taken this entry thinking this was a YouTube model, right, that would have been solid too. Way solid, 50 plus points. But the real question is, would you have trusted this, right? Would you have was there enough evidence for you to trust that this would have held and continue to go lower, right? You want to ask yourself that question, and if yes, tell yourself why. If no, tell yourself why, and don't be mad or upset at yourself if you do say no. You're not expected to catch every move, just like I'm not, just like ICT's not. You know? So yeah, as you can see, there's been lots of different ways to view things. Lots of different areas that you could have considered taking an entry, right? Or had a thought process around to make sense of it all. Again, we have not changed our higher time frame bias. So because price kicked down lower, it's not a surprise, right? We did talk about what causes a Thursday or Friday reversal, what conditions would lead to that, which is generally a one-sided weekly range that hits a higher time frame premium or discount array, depending on the bias, in this case a discount array, on a Thursday or Friday. That would trigger a potential retracement. That doesn't change the overall bias from the higher time frame. That just means it's retracing, and that's normal. Maybe you would take a loss because it retraced. That's fine, but you need to remember what I'm saying. You don't lose focus of the higher time frame. You can't get lost on the 1 minute or even the 5 minute, 15 minute. Those time frames are only effective when you're able to understand, at least from my experience, what the higher time frame's doing and what narrative you're inside of, which in this case is a market maker sell model on the higher time frame that we've discussed all week, as well as last week when it comes to the DXY, which was in a market maker buy model. So yeah, I hope all that makes sense, you guys. I think we've pretty much, at least for the AM session, I think it's pretty much printed most of what I think it's going to do. I mean, it may slide off if DXY does want to continue. But I feel like we've done a lot of work inside this price delivery. I think we've pulled out a lot of things. We've definitely discussed a whole lot of topics from SMT to, validating a move, inside of the move, reasoned with different changes in price delivery in terms of how to use SMT between different assets, from the interest rates to the so because the AM session was really fast, that may cause PM session to either be slow or really ram it up, up their ass, like to the buy side. So it just really depends. When AM session is really fast, the PM session generally is going to be very deceiving, because everybody in the PM session after lunchtime is going to be like, oh my God, I want to get into the sell. It's sold. And oh my gosh, it's probably going to continue. And little do people know, all the things that we've discussed have to be put in place. Well, for the PM session too, one thing you can consider is going into the lunch hour. You want to pay attention to the lunch hour high and low, and then just see what's happening. And ideally, if we're going to continue being bearish, we want to see the lunchtime high get taken, because that's where AM session stops will be, to then try to consider the continuation to the downside. But that's the thing, if the DXY does not want to continue going higher, then it's more likely that they're going to try to punish buy side delivery or buy side liquidity, because that's where all the sell stops are going to, that's where all the buy stop losses are going to be, or the sell stop losses, my bad. So again, this little area here, you want to study how this order block is either respected or not. You also want to take into consideration what the DXY is doing as well, and how that's affecting the PD array delivery. See, and then PM session trading, there's a whole mindset that has to go into that as well. That's why you want to pick one session. That's why I only trade the AM session for the most part. Unless I can't trade the AM session, then I either don't trade that day or I just go into the PM session with the mindset of the PM session. Basically is like what happened last night, what liquidity has been taken, where's the lunchtime highs and lows, and what liquidity can be attacked given what we understand about the higher time frame. Very chaotic. Yeah, it's been pretty. Yesterday was worse. I feel like yesterday was a worse AM session. Like, look at the viciousness that occurred. Like, all up until the thing, it just manipulated. But then it did deliver. We were in front of what occurred yesterday. Yesterday was a pretty decent day, too. Yeah, I didn't even get a chance to trade on Tuesday. But the thing is, all week I have been basically calling for price to go higher to create the buy side of a market maker sell model. Then we created a smart money reversal yesterday, which was fully anticipated. And then now we've just basically continued to deliver within that market maker sell model framework. So I still believe that we are in the market maker sell model. I still believe that we have not fulfilled completely the second stage distribution delivery. And of course I could be wrong, right? It could just pause because of what the interest rates are doing. If they choose to not move, that could give us a slowdown in these other assets, right? But DXY has also kind of turned around aggressively, came and basically punished all these people that were winning in the buys. They took them all out pretty much. And they also did their work here, so they stopped out sell stops, rammed it up to the previous day's high, swept the liquidity from yesterday, which was set as equal lows, and then just basically came all the way back. So the last 2 days for the DXY, I mean, if you look at it, it's in a range bound consolidation now, inside of the daily fair value gap, which is this blue box here, which is also inside of the weekly fair value gap. It's on the weekly chart. And that weekly fair value gap, the midpoint of that is being respected. So that's showing to me that, in all honesty, I think we could still trust the overall bias. But as you can see, price is now all of a sudden stalled out inside that discount array. And we're towards the end of the week, pretty much. So, that can have an impact. And then, of course, all that aside, think about the chaos that's happening in the world with the US dollar and all these other things that are going on. Every little thing that's happening geopolitically is going to have an impact on what the market does, how clean the market is, how logical specific things are. We're also in black swan season. So like bombs could be dropped at any given moment. War can break out at any given moment. So these are all things we have to consider as we're in the market taking risk. We have to realize that it's elevated. So not only do we have to pay attention to what we're already doing and make sure we're staying in line with our rules and our performance as a trader, we also need to make sure that we're not oblivious to the fact that there is other risk lurking in the background that can directly impact us as traders. Which I say that all that to say that you just need to be very attentive with your risk management. This is not a time to be betting the farm on anything, over risking, over trading. All that stuff needs to be at a minimum, if not completely removed by force to yourself. Because, the worst thing you could do is try to learn and then get a black swan event happen, removing your whole ability, whether that's blowing your funded account that you've worked hard for, whether that's blowing your whole account in general, as like a privately funded trader. whether that's a small account or a big account, that's the worst thing that you can possibly do, right? Stick to the rules. Take my advice. Take 1 to 2 trades. If you take a trade at, say, 1%, your next trade, if you took a loss on that 1% trade, your next trade needs to be dropped by half. So you'd be risking 0.5%. And then you don't move back up to that, 1% until you make half of that loss back that it was initially made, right? And you keep it that way. Because any given day, if you consider what I'm saying, any given day, the most you can lose is 1.5%. And then if you lower your risk the next couple of days, if you continue to take losses, it'll still be very minimal losses. You will never have a chance to blow your whole account in a day or 2 days or 4 days or a week. It will just never happen because of the rules. That's why the rules are important. They stop ruin. They get in front of your ability to be a human being and be imperfect like we are. That's the importance of the rules, And some people will think, oh, well, putting those limitations make it harder for me to make more money. Well, it may take a little longer, but that's teaching you discipline and patience. And it's also protecting you from not having an opportunity at all, right? Like, would you rather risk not having the opportunity to try to risk and make more? Or would you rather have longevity, continue to grow into the trader you're trying to become, develop good habits so that when the time comes that you are profitable, you can maintain it? I think that's a better, more mature, adequate mindset in terms of a professional view versus being a reckless gambler that's addicted to just taking entries just because those people don't last. And I'm assuming since you guys have been here with me for such a long time today, and you guys are continuing to hop on and listen to this type of stuff, that you're a serious individual trying to actually learn how to do this effectively. You're not here just to, get like one win and be done. Like, you're trying to have either a side career, an extra income, or a full-time income off of this. And that perspective, even if you're doing it part-time, requires a specific mindset. They always say that trading is the hardest way to make easy money. Well, at first, it's damn near the most impossible way to make easy money because there's a lot of things we don't know. And, it's just like anything else. We gotta practice and take time to learn. But if you don't give yourself the opportunity to learn because you blow your opportunity because of impulsiveness, those are avoidable pain points, avoidable mistakes, So, and then eventually when you do get enough understanding and skill set in this industry, you are able to turn this into easy money. Right? Doesn't mean you're going to win every day, but that does mean that money will flow a lot easier and your mindset will be a lot more calm because you'll have more trust in yourself and you'll be able to understand how to actually navigate as a effective professional day trader, not a reckless social media gambling psychopath. Right? So yeah. So now, seeing what's happening here, this treatment that it's giving this order block here would make it so I am now completely uninterested. The fact that we've basically died out and now we're in a range-bound consolidation, basically ahead of the lunch hour, it gives me less interest to want to really even consider any type of engagement. Because, if you just think about it, what's now here besides this order block? What's now here that would make sense to me in terms of my model or the models that I use? The only thing is we're working inside the higher time framework that we've had painted since the beginning of the week, which is that market maker sell model. Right? So until something changes, right, and gives us clarity as far as, is price ready to move or not, we sit on our hands and we wait. And sometimes that would mean, no more opportunities are present for you. And we've already called out multiple situations that provided potential opportunities. Right? We've already considered potential moves that could have been executed on. Right? We've already broken down a ton of logic, a bunch of different things. Right? So this is putting in the reps. And the ones that aren't doing this type of thing, the ones that don't enjoy putting in the reps for themselves, just like I said earlier, how they remove themselves from the opportunity. Well, not putting in the work, not turning this into something you enjoy, will also remove your ability to, be able to flourish in the industry or just as an individual trader. Because if you don't enjoy this, if you can't sit and find enjoyment, it's just like a brutal thing to do every day. I mean, it's it'll be very hard to deal with the hardships. So you have to make this mean something to you. Like I always tell my mentorship students, you have to make this mean something to you. You have to attach your ability to follow your rules and to do the right things to something that you care about. Like mine is attached to my daughter. My risk management, since she's been born 4 years ago, has always been attached to making sure that she can be provided for. And if I break my rules, I'm basically looking that little girl in the face and saying, I could care less. My reckless impulsiveness is more important than making sure I can provide for you. And I refuse to let that be part of my reality. It's just like, who the hell would think that way? And it's a lot easier to let ourselves down than it is to let down someone we care about. So that's why I say you want to make this mean something to you. Peg your ability to be disciplined and your need to be disciplined and follow your rules to something that you care about. Very important. But yeah, you guys, I think I'm going to call it a day. So I appreciate all you guys spending such a long time with me. I may go live again tomorrow. I'm still trying to decide. But if not, I will have a weekly prep call recorded, posted on Sunday. And then I will continue to go live either Tuesday and Thursday or Wednesday and Thursday, just like we have done this week. Sometimes it'll alternate, but I'll make sure I let you guys know. Definitely keep tabs on my community tab, and definitely follow me on Instagram, because I do a lot of updates and try to be really active communicating with everybody there as well. So Instagram, community tab, and Tuesday and Thursday, or Wednesday and Thursday, we will always be here, okay? So yeah, I appreciate you guys hopping on. God bless you guys, and I will see y'all on the next one.